it's clear that the Bank of Japan is going to hike next year.
It's the end of an era, and investors have to get used to higher interest rates across the curve.
Eventually, this is going to bite, and inevitably, when the recession comes, spreads are going to widen further from here.
The global economy is likely to be heading into a recessionary path.
I think we're in a rolling recession, or we're going to get one. That's a dual cycle.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is the end of an era. It's my last show.
Ever?
Of 2022.
Woof.
See you in 23. He was getting excited. Live from New York City this morning. Good morning. Good morning with Tom Keene and Lisa Abramowicz. Welcome back, Lisa. I'm Jonathan Ferro. Equity futures up 0.5% on the S&P 500. TK, we can finally talk about some company earnings. FedEx, Nike in the mix this morning.
I'm glad you lead with this. We'll do a lot in Japan here. We're going to talk about the show yesterday and the path forward for Japan. But you're right. There were some earnings, and I looked at FedEx very carefully, the guidance ballet, but, the stock's pretty much unched. I mean, it was like okay.
You want the good news? It wasn't a repeat of September, because September was pretty brutal for this company.
Yeah.
Although, if you look under the hood, it was fascinating. They raised costs and they cut costs. They raised prices and they cut how much their expenses were. Volumes were down. This doesn't necessarily indicate a healthy economy. What it indicates is, to your point, Tom, companies adapt and adjust, and what adapting and adjusting means is cost cuts and higher prices.
Can I anecdote here? The cardboard box pile-up outside my walk-up, I've never seen.
This is a major data point for you, isn't it?
It's got to be 30% bigger than the pile last year.
It's that time of year, though, Tom.
I
the boxes arrive.
But I mean, anecdotally, I'm with Neil Dudd on this. Is Dudd on today? I think he darkens the door.
8:15 Eastern time.
He darkens the door. That'll be good.
To Lisa's point, though, you can say the same thing about Nike, I think. Another inventory build-up, which may be of concern to some economists out there. Perhaps that feeds into this idea that you get more goods disinflation, but at the same time, sales profit better than expected.
So consumers can spend. They are being perhaps a bit more cautious with how, and yet a lot of these companies are still able to raise prices. Again, it flies in the face of the narrative that there is some sort of bigger concern.
And Nike up more than 12%. This morning. We'll pick up on that story a little bit later. Futures right now up 0.5% on the S&P. Here's the price action for you. What day is it? Wednesday morning?
It's
Wednesday morning.
Stay focused, John. Stay focused.
It feels like a Friday, Tom.
It does.
Your 10-year,
for you, it's a
367.87.
I mean, it's not.
Yields unchanged in the FX market. Euro dollar negative 0.1%. 106.16. I noticed in Japan, Tom, the 10-year getting close to that upper limit of the band.
Yeah.
Getting close to 50 basis points.
Well, all of our team yesterday was yeoman's duty on talking to you about this historic moment for Japan. I think that sort of dawned on the American financial media through the morning and even into yesterday as well. And my major message there, John, is there is follow-through this morning. There's a dawning awareness. This was a big deal. And as you mentioned, yen comes in stronger right now through 133, through 132, 131.85.
Lisa, the Japanese 10-year, 0.47% this morning.
I just found this story fascinating. I'm sure we'll tease it out throughout the day, but some of the biggest moves that we've seen this decade, not only this decade, but since 1998. All right, here's what we're looking at today. 10 a.m. we get November U.S. existing home sales, as well as December Conference Board consumer confidence data. How much do we get a sense of the slowdown in the housing market? The data has been somewhat mixed, actually, of late, although existing home sales already at the lowest going back to May of 2020. Can it go much further? Today, Sam Bankman-Fried has agreed to be extradited to the U.S. The expectation is he will fly back accompanied by FBI agents, and then the hearings begin about what his guilt is and whether he will serve potentially the rest of his life in jail. And at 2 p.m., President Biden is greeting Vladimir Zelensky, the president of Ukraine, on the South Lawn of the White House. 4:30 p.m. press conference. Vladimir Zelensky is asking or expected to receive $2 billion as well as certain weapons, a system that to me is going to be fascinating to see, John, how much they get some of these high-tech missiles that can potentially blow Russian missiles out of the air to defend themselves. Do we find out more about what the strategy is heading into the winter?
Hey, Lisa, thank you. Thank you very much. Fantastic to have Lisa back. TK, there is a belief, reports out there, that this meeting doesn't take place without a big deliverable.
Yep.
And that deliverable this morning is expected to be that Patriot missile
I would
defense
spell
system.
it Patriot as well. It's a good morning for Raytheon. I've been informed by people way in the know on this. There are different kinds of Patriot missiles, and you've got to wonder which ones were delivering to them. They're what they are, but they're maybe not the most sophisticated ones.
We'll get some detail from AMH in about 10 minutes' time down in Washington, D.C. Joining us now is Brian Weinstein, the head of fixed income at Morgan Stanley Investment Management. Brian, your words this morning. Risky assets are overly optimistic that the Fed pivot will come before the pain. Brian, is that optimism misplaced?
Yes, I think it's misplaced. I don't think it's wildly misplaced. I think people always get images of '08 in their heads, but the market always wants the easier path, and it's not that clear to me it's coming. That Fed statement, now maybe overshadowed by the BOJ, was very hawkish, and I think the pivot will come next year, but not until risk assets have given up a little bit of the gains we've seen them make. It's already started in equities.
Brian, what's 60-40 do this year? One of the great hallmarks of the last 24 hours is awareness equities and bonds tanked. Bonds have to come back. Is it a year of clipping coupons, or can you find total return?
I think it's a year of clipping coupons plus a little bit. Like I'm not a big believer we go back to 250 on 10-year notes, or that the Fed eases right back to zero. But I do think the income opportunities out there are real. So I think you get income. I think when you can buy 10-year notes in this kind of 375-ish range, you can get income plus a little bit more. So I think it's a decent year for 60-40. It may depend more on equities than bonds, but I do think the income part of bonds will do very differently than it did last year.
I think I've got a good understanding how CFOs react when we had the incredibly low yields, money for nothing, money free, and we saw, these hilarious bond tranches by tech companies. What does issuance look like when money actually costs something?
Issuance slows down a little bit. I mean, again, I think it depends how quickly the Fed pivots. One thing risk assets may be telling us is that they can hold out a bit, right? No one has to refinance at 10% on high yield bonds. Well, some folks do, but most don't. And if you can wait a bit and rates normalize and spreads are okay, you can refinance it 6-7%. So you don't lever up as much, you don't borrow as much, and so I think issuance will pick back up, but it's not the same as when rates were zero, right? The 0.25 tranches or under 1% tranches were just too good to be true for companies. I don't think that's coming back.
Brian, throughout this year, people were talking about the risk factor that China would reopen, it would cause more demand and more inflation, and that the Bank of Japan could potentially drop their yield curve control pegs, and that would cause massive disruption and much higher yields. Both things appear to be having hints of happening, and yet this market is chugging along. Yes, there was a bit of a disruption yesterday, but not as big as many people would have expected. What do you make of that?
Yeah, at least I was surprised yesterday. So you look back and wonder why, right? Back when the UK mini crisis was happening and yields were spiking, that kind of price action was what people expected when Bank of Japan did this. Now, if you look at their yield curve, other issues, you could argue that the market had sniffed it out, right? There were issues that were trading reasonably higher than the peg, and so maybe it was just more in the market. But maybe listen, what it tells me is that we've seen our highs in yields unless we have some other shock. If you had told me just what you said, that China was reopening more and that Japan moved their peg and that 10-year notes went from 340 to 370 and they'd been 4.25, I would have yawned, right? It's not the story that people want it to be. So either the market's asleep and it's quiet, which I guess is possible in December, either that or the market has sniffed it out and it's in the price already and we're moving on to something else. It's very interesting to me.
I would agree with that, especially because the theory was that Japanese investors had piled into U.S. Treasuries and would withdraw completely and go back home as soon as there was a sense that there could be a free-floating type of bond market. Granted, they haven't done that. They've just adjusted the yield curve control sensibly. Do you look for some other indication that we have seen the peak in yields, that this isn't necessarily going to be another shoe to drop? Or do you think that the jury's already come back with that verdict?
No, listen, again, I definitely lean towards the fact that we've seen the highs in yields because, again, I think you look at what the bond market's telling you. It's telling you the Fed is going to win the battle against inflation. It's telling you growth is falling, not disastrously, but definitely going low. I mean, the Fed told us that where their prediction is for next year. So there's a lot of reasons why we're looking through this maybe and into lower growth and lower inflation. So yeah, it kind of gets rid of your list of what you thought might drive yields higher. I think you'd have to see GDP numbers surprise consistently to the upside, and a Fed that's good. Maybe they don't have to go to 6%, but they could stay at 5% all next year, and then you have to reset rates higher again. But I don't think we're going to have that information for a while, and I'm actually not convinced it comes.
We want all the excitement up front, Tom, all at once. It takes time. You've got a new band. You've got a new upper limit to that band. It's 50 basis points. we've got to see if that gets tested, the upper limit of the band in the next couple of months, and when Governor Kuroda exits and someone new comes in.
Yeah, I agree it takes time, and it's also about flows. It's not just an interest rate analysis. It's about what do the Japanese do with a huge amount of cash abroad. Some really smart notes over the night, rather. I like what George Saravello said about yen strength from this wall of international money that will return to Japan.
We're going to catch up with Eric Nelson of Wells a little bit later. Yeah. $125 yen, that's a major call.
Yeah,
125 from where we were pushing 150.
On a nonlinear basis, it's amazing. What do we do after 125? I mean, I don't see people really framing out 118, 115, 110, but I would suggest it's nonlinear, and the easy move has been made 150 to 131.
Brian, can I squeeze this in just quickly? I want to talk about Europe. We've talked so much about the BOJ in the last 24 hours and what has or hasn't happened with JGBs. The Italian 10-year before today was up more than 50 basis points, the 2-year rather, over 4 sessions. Not just the Italian 2-year, the front end of Germany, the 2-year there up almost 40 basis points over 4 sessions. Brian, these are real moves. For people talking about the end of the shift higher in bond yields, what's happening in Europe?
Yeah, no, Europe is interesting. I mean, a very hawkish ECB and an ECB that really controlled a lot of those bond markets. So listen, you hear a lot of things about, what if the Japanese investor stops buying treasuries? I'm fairly confident the treasuries will get funded. They're liquid. The world's benchmark, whether it's good or bad, is a different story. I think where you can see more trouble is in the risky assets in Europe, where the markets haven't functioned as well, where the ECB has been a bigger player, and so you have big moves there. But it's not as obvious to me that those moves are over.
Hey, Brian, this was great. Fantastic to catch up. What a move from the BOJ. Unexpected going into the new year. Brian Weinstein there of Morgan Stanley. Take a look at these scenes in Buenos Aires. 4 million people descending on the capital of Argentina, hitting the streets, Tom. There was meant to be this open bus tour, parade of the World Cup with the team. That got abandoned pretty quickly.
Yeah.
And the players had to move to helicopters to complete it because that open-top bus couldn't move, Tom.
And it's Wednesday, and am I right, John? They're playing their real job, their day gig on Monday or Tuesday?
Premier League.
And European...
Commences again, Monday.
Like PSG's not in the Premier League, right?
No, that's the French league.
Do they play each other? That would be fun.
That's
like
in
Liverpool,
the Champions League. You're describing the Champions League.
Is that still going on?
You've just reinvented the Champions League. That continues.
Okay. I think I like Premier League better than World Cup.
You prefer the Premier League?
Is that odd?
No, there are some people that think the actual quality of the football might be better at the club level, at the upper.
That's how I felt.
Upper tier of club football.
Even better, there's no
Champions
Fox
League,
announcers. Oh,
we can talk about the ratings. The ratings are in. I'll bring those numbers next. Eric Nelson's coming up shortly, 7 a.m. hour, so in about 45 minutes from now, on this BOJ decision. He's got things to say over at Wells Fargo.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. President Biden will unveil nearly $2 billion in assistance and announce moves to deliver a Patriot missile battery to help Ukraine bolster its defenses this winter. The U.S. State Department says Iran's shipments of drones to Russia for use in the war in Ukraine is transforming relations between Tehran and Moscow into a fully fledged defense partnership. Ukrainian President Volodymyr Zelensky is traveling to Washington today to meet with Biden and also address Congress. It is Zelenskyy's first trip outside of Ukraine since Russia invaded back in February. Now, Chinese President Xi Jinping has told former Russian President Dmitry Medvedev that his nation would like to see talks on Ukraine. The remarks come as Beijing tries to improve ties with Europe. State broadcaster China Central Television is reporting Xi told Medvedev that his administration has been actively promoting peace and also talks. China has avoided criticizing Russia over the war in Ukraine. China has confirmed it has narrowed how it defines a COVID death, counting only victims who tested positive for the virus and then died of respiratory failure. The decision adds to speculation that China's low official tally is hiding the true picture of the chaos unleashed by this month's abrupt pandemic pivot. The entire country has reported fewer than 10 deaths this month. Global news 24 hours a day on Bloomberg. I'm Leanne Gerrans.
what are the real needs of the country right now, making sure the Defense Department can deal with the major threats coming from Russia and China, providing assistance for the Ukrainians to defeat the Russians. That's the #1 priority for the United States right now.
President Zelensky heading to Washington, D.C. That was Senate Minority Leader Mitch McConnell from New York City. Here's the price action for you on the S&P 500, snapping a 4-day losing streak in yesterday's session, just about. Equity futures right now up 0.5% on the S&P. In the bond market, yields unchanged at 368. Tesla up by just 1%, was up by more than that on the month so far. With yesterday's losses of 8%, we're down by 29% month to date on that stock, Tom, with all this speculation swirling as to what will or won't happen with the leadership over at Twitter and ultimately what it means for the leadership at Tesla.
I'm glad you bring this up, John. We got to get to Anne-Marie here, but what do they do today? What does Tesla do today after the price action yesterday?
One report just came through from Electrek, Tesla to implement a hiring freeze and another round, a new round of layoffs, Lisa. So these reports keep coming through, but Ed Ludlow's been talking about this. I think investors of Tesla would like to hear from the company, and not just these reports from different media organisations. They'd like to hear from the company directly at this point after the weakness we've seen, particularly over the last month.
Who's running it day to day? Are the concerns that you're seeing in stocks truly due to anything fundamental with how the company is being run and with respect to some of the demand issues that you're seeing over in China in particular? Or is this due to potentially some risk tied to Twitter and Elon Musk's focus there and what the collateral could be of Tesla shares for some of the Twitter loans?
I think the question that Ed and I have been exploring, and others as well over the last couple of days, last couple of weeks, do you have a leadership problem over there or just a macro problem? And does the stock have a leadership problem or just a broader equity market issue? Because I go through the names. Listen to this. Meta year to date, down 65%. Apple's down about 25%. Amazon's down 49%. Google's down 38%. Microsoft is down 28%. A lot of these big names, big tech names, if you want to call Tesla that, maybe you don't want to, but a lot of these names that have had weakness off the back of higher interest rates, they're all in the same grouping, aren't they, year to date?
You could say that, but if you look at the actual correlation of the price action to some of the drama around Twitter, the correlation is pretty direct. So there is a question about the reputational risk. And Dan Ives, I know, has spoken with you about this as well. How do you tease out the man from the company if the man has really represented and sold the company and really created the fan base that drove Tesla to what it is?
Well, Dan's super bullish on the stock still, Tom, and Dan's been pretty clear. He wants Elon Musk out of the Twitter situation and focused on Tesla. I think that's going to be difficult to make that happen, even if he steps down as chief twit, as he calls himself over at Twitter, and then install a new leader, because he's still going to be heavily involved, Tom, in that company.
It seems to be a lot of damage, is how I'd put it.
Particularly over the last month.
You know, I talked to our head auto guy at Bloomberg News, and he was heated here. The competition coming Tesla's ways is huge. Like 20 cars.
Sure, and look at the manufacturers.
20 varied cars.
Look at the American car manufacturers this year.
Yeah.
They haven't done well either. Those stocks are really suffering.
They don't have Teslas on the back of Patriot missiles. Let's get to that. Anne-Marie Horton gives us a brief this morning. This is really interesting. Each missile is well in the X number of millions of dollars. They're on the back of a truck. They take a lot of staffing. They're fancy. And, of course, the memory of the Gulf War when Raytheon launched these what are considered wonder missiles by defense experts. Anne-Marie Horton, how many of those missiles will Ukraine have?
We're still getting details on exactly what will be announced. We do know that the president is going to be announcing that they are sending these Patriot missile batteries to Ukraine. Ukrainians will be the ones that are staffing them. They're U.S., according to a senior administration official who briefed us reporters last night with the news that President Zelensky will physically be here in Washington, D.C. today. The fact of the matter is, they said they are not changing their policy of troops on the ground. But Zelensky has been pushing for more high-level defense weapons, and he's getting them today.
Will those missiles be able to land in Russia or take out missiles launched from Russia?
I think the idea is that these missiles are defensive. And right now what you have seen, and this is why Zelensky has been pushing for it so much, is really a barrage of missile and drone attacks on critical Ukrainian infrastructure. We've talked about it a number of times. Many analysts have said it, and it is playing out every single day in Ukraine. Putin is weaponizing winter. He is really starving civilians of the power and the energy that is needed. And this is something that is critical, obviously, in the very harsh, cold cold winter months in Ukraine, especially eastern Ukraine, where the fighting continues. And that's where Zelensky was yesterday. So, Tom, these missiles, the hope for the Ukrainians is that they'll be able to shoot them down and directly hit Russian aircrafts and missiles.
Anne-Marie, we've heard about Patriot missiles being delivered to Ukraine for a bit now. Why the significance, why the importance of Vladimir Zelensky coming in person to Washington, D.C. to meet with the president and lobby the cause?
So this is incredibly significant, and to be honest, I think many, including myself, were in shock. He's leaving a war zone. He was just in Bakhmut, a really central area of Donetsk, of fighting. Just yesterday, he was handed a Ukrainian flag by the soldiers there, and actually he alluded to his trip, and many didn't see it, saying that he is going to pass this on to U.S. Congress and the President of the United States for their support. It is coming at a critical time. I've mentioned once because of obviously the weather. Ukrainian officials have also been telling the press that they do believe that as soon as January, maybe February or March, if it's later, that Russia will attempt a fresh take on Kyiv, especially from Belarus. This is on the heels of President Putin being in Minsk just earlier this week on Monday. And then second, this is really Zelensky's appeal at a joint session of Congress this evening to Republicans that are taking over the House that have said they do not want a, quote, blank check in terms of funding to Ukraine.
Right now, we're also hearing about Xi Jinping meeting with Medvedev of Russia on the other side, urging for talks, urging for peace. How does the U.S. give aid to Ukraine without seeming like they're moving away from that kind of reconciliation and being more antagonistic than defensive?
Well, I think the United States has said constantly nothing about Ukraine without Ukraine, so they would welcome peace talks if Putin was going to leave Ukrainian soil, as Zelensky has said. The U.S. has always been sending funding. I don't think the Patriot missiles or the extra $2 billion funding nearly $2 billion the president's going to announce today, has really changed that calculus. This is something that they have started since February 24th when Russia invaded. What is interesting is China's tone yet again shifting slightly, and directly to Dmitry Medvedev. He is the former president of Russia, and what Xi Jinping is saying, and this is almost an olive branch as well to the Europeans and to the United States, is that China wants peace and they want talks. And he's saying this directly in public to, really a key Russian player, maybe not so much inside circle of Putin yet, but he was Russian president when Putin stepped down and became prime minister for those few years.
Mate, just quickly, you were at the G20. It feels like to me that since the G20, there's been a real shift from China, just in tone, with the rest of the West. What happened over there?
So you're 100% right. There has been a shift in tone. Still, China has not come out and condemned the war. But what they have done is they've signed on to the communique that said most of the countries at the G20 are against this war of Ukraine. They allowed that line. They didn't name which countries were there, but China allowed that. And China has continuously said they do not want to see a nuclear war. They do not want to see nuclear weapons being used. Obviously, this is something that Putin has continuously flirted with in terms of his language of maybe digging into his nuclear arsenal. China is questioning, without directly saying it out front, Russia's plans. And we also saw that moment as well when Putin said to Xi, I know you have some questions and concerns.
AMH, down in DC. Anne-Marie, thank you. I think we can all feel that shift, Tom, since the G20 in Bali for the Chinese leader.
Oh, yeah.
There was a feeling going into it that China might be isolated by the United States and other nations, and that just didn't really take place.
I believe it's winter in China. Can you imagine the weekend
Tom,
that the president faces?
Have you heard from President Xi on COVID?
No.
Nothing. Tumbleweed.
But I just like to get to Monday in China, I would suggest it's a medical challenge.
I hear you. On some of this, Christian Knowlton, the Chief Investment Officer over at Deutsche Bank, Private Bank. Wednesday morning, every day this week's a Friday, isn't it? As we approach Christmas Day, Tom. Just,
Would you like to leave an hour early?
I plan to leave about 30 minutes early.
Brianna up at WCVB just showed Logan Airport in Boston, and it's like, the holidays started.
It's getting busy.
Packed.
Amazing.
Lisa and I can do this.
Well, can I
I'm confident you can. I'm confident you can go solo, Lisa.
Do you like my coat?
We don't want you to go.
I got people on radio talking about my coat. I wore this for you. It's my festive,
So what's with that? What's the story behind that?
It's a festive coat. I was with Christine Lagarde, and she was doing the houndstooth thing, and she said,
great idea. It will strobe on TV.
Yeah,
it'll really work.
Great. It works out well.
Same thing. Merry Christmas.
No, on my return monitor, it's not strobing, but I'm sure there's someone at home that's just seeing these.
Yeah, we're waking them up. I was going to wear my Christmas sweater, Lisa. It has the ISLM aggregate demand, aggregate supply geometry on it.
That's
fantastic.
With lights. Yeah, exactly.
With lights blinking off.
Have you actually got one of those?
Yeah, I do. And then, after the 5th mince pie.
Oh, mince pie.
There's a supply shift.
I'm sure you're about to say something.
There's a supply shift.
I think it was martini.
The ISLM.
Mince pie.
Supply shift.
If everybody's gone, is everybody kind of scrambling to get back because the year didn't end because there are these random shocks?
No.
Okay.
It's year over.
When are we back all together?
2023. Early January. Can't wait. Equity futures right now on the S&P. Positive by 0.5%.
It's the most disingenuous can't wait ever.
Everything I say is genuine. All right? I mean it. It's truthful from the bottom of my heart.
Oh, dear Lord.
If I can find it. On the NASDAQ, up a third of 1%. In the bond market, 2s, 10s and 30s look like this. Your 2-year, just some fantastic calls from Mike Schumacher of Wells Fargo yesterday. He's got 2-year nominal yields. He thinks in the next few months we can get back to the high 4s. Right now, the 2-year, 423.38. He thinks on a 10-year, the 10-year can get back to 425. He thinks real yields are going higher as well. So it's a big call from Mike Schumacher, and hopefully Eric Nelson can touch on that a little bit later, Tom.
Lots of nuances as well. I mean, there's just no question about it. Christian Nolting with us, with Deutsche Bank, along with Michael Schumacher. And so much of this is just the different views, particularly institutional quiet money views. Christian Nolting joins us right now. Christian, I just want to know what 60/40 is going to do next year. I mean, the serious quiet money, John Farrow's 401k is blown up to smithereens. I mean, how do we get back?
Well, I think a very good question, actually. And I think what we have seen today is that the so-called traditional asset classes 60/40 have been going in the same direction, i.e. down. And I could imagine it's staying the same direction for next year, but slightly up. So we call it a little bit the recovery of the 60/40 probably for next year. Why? We think there is a recession both in the US and in Europe. From that point of view, we think yields could go lower from our perspective. So that would be positive, of course, if you look at the return. And on equities, we are also cautiously optimistic, especially in the second half of the year. So maybe from that perspective, it's not too bad as this year, maybe.
What do you see from the huge sell-side analysis in your internal corporate analysis, not only Deutsche Bank Europe, but Deutsche Bank Global? What is the tone of corporations this after we saw Federal Express and Nike in the United States?
Well, I think it probably the next year could be really split in two halves, right? As we are going for a recession, I think companies are also cautious. And from that perspective, you would see also the next earnings season, i.e. from Q4, then in January, that there's a bit more cautiousness that could weigh on markets from that perspective. But I think in the second half of the year, as I mentioned, if we are behind recession and we are not going for a long-dated many-quarter recession, then the outlook should really improve, and maybe a bit earlier even, so if the market is discounting that. So from that perspective, I talked of this two half of the next year.
A lot of people are talking about the two halves of next year, and that kind of hinges on the weakness coming through in the first half of the year. What are you looking for to determine whether the thesis is accurate in terms of the earnings disappointments, in terms of the response in markets?
Well, we look especially of earnings expectations, right? If you get the real numbers, you always have to check what the market has been thinking. The good news, in a way, comparison to last quarter, now earnings expectations have come down a bit. I think that's honestly a positive sign. But if you're right with the recession, then probably we have to lower this a little bit as well, or the market has to lower earnings expectations from that perspective. And so I think that's important on the one hand. And then if you look top down from the macro perspective, of course, you look where inflation is stabilizing, or is inflation really turning? And I think the Fed has said it. they will want to see not only one, let's say, spot, they want to see 2-3 consecutive months of inflation coming down. I think that's, from the macro perspective, very important to watch.
Here's what's really frustrating me, Christian. Everyone's coming on and saying this. So it seems like lower earnings expectations are pretty much baked in. People are saying they're expecting lower lows so that they can go in and buy, so that they can enjoy the second half and see those gains. And they're expecting some moment of panic. Except we've seen all of the panic instruments, at least that people were putting out this year, from China reopening to Bank of Japan potentially changing their yield curve control. What will it take to surprise what is a consensus right now of a lower first half and a better second half?
Well, I would say, honestly, I'm not thinking we are going into a panic mode. We have been saying there is a recession quite early, actually. And if that's the case, yes, but we have also been saying that this recession won't last for very long. I'm not sure we really see the lows we have been seeing already. So I think we also agree with that we can see a lower market. But I think then we have to be very disciplined and say, if the outlook is correct, that there's not a long recession, then we need to use it as an opportunity. And I'm sure if everyone sees the market coming down, it will not happen, right? We know that.
Look, Christian, I've been reading a note here while Lisa's talking from Dana Telsey, who's acclaimed in retail, and it's on Nike. And to me, Christian, it looks like a repeat of the quarter before and the quarter before that. And you've been great about this, measuring, it's just not going to be as gloomy as we see. Let's take one company in America. Granted, it's a fancy brand. And should I ask him if it's Adidas or Adidas? I don't think we'll waste time on that. The Christian, the basic idea here is, are we overdoing the gloom? Dana Telsey really pushes against that this morning with Nike.
Yeah, I think people are surprised if it's not that bad. As I said, we are not forecasting a deep and very long recession, but let's not be too optimistic, right? I think the environment is going to be tough. And from that perspective, we should really be not too optimistic and say, let's forget about this, everything will be fine. It will not be. I think it will not be an easy year, but there will be opportunities. And to answer your first questions, Adidas, from Adidas.
Clearly.
Thank you. See, I'm learning every day.
I like to adapt to my surroundings. I call it Adidas while I'm here. But back home,
that's fine.
You're very flexible.
And I would also say in the UK, we used to call Nike Nike.
Really?
We called it Nike growing up, yeah.
Interesting.
But I've adapted here too, and I'll call it Nike, mainly because people don't understand me when I try and buy clothes and shoes and stuff like that.
Christian's like, why am I doing this?
What a Nike.
Christian, seriously, what's the value of cash with all this? I mean, you guys are pretty optimistic, and, I'm there. But what do you do with cash that actually has yield?
Well, actually, look, for a long time, I can tell you here in Europe, right, we had a lot of cash on the accounts because there were negative rates and we could avoid them for the clients if we have them on our discretionary accounts. Now we've moved the cash into short-dated bonds because now you earn something there, which is a massive difference. So this year, clients will see much lower cash positions than they have had seen last year. Still, I think we can, if you look at money market funds, we are still ready to deploy them probably in the first or second quarter of next year, given the view we have.
Given that a lot of people are talking about this, do you see another rise in rates, especially based on the latest moves, the hawkish move from the ECB and what happened with the BOJ?
We do see a slight rise in rates because I think inflation will be sticky. So everyone is talking about inflation to come down, which we agree with. And probably we've seen the trend changing in the US already. Maybe in Europe it's coming only, maybe next month, maybe in February. But I think the market is then too optimistic that there's only a downway to a very low level. We think inflation will be higher. And I think once the market is realizing this, we could see slightly higher rates. But again, as I said, it's probably still interesting to go in the fixed income space because we don't see not by far the same move as we have been seeing this year, which I think is not a difficult forecast to be very honest.
Christian, this was fantastic, sir. A happy New Year to you and have a wonderful Christmas. Thanks for joining us. Christian nodding there.
Same to you.
Deutsche Bank with a beautiful German backhand there. Just fantastic.
It's Adidas. Just to let you know.
I love that. Do you know it's got a great outlook? Michael Purvis of Tallbacken has got a fantastic outlook.
Read every word like 3 days ago.
So you talked about that first half, second half story. Michael's having none of it. Year end 23, 36.50. He's looking at the structural disinflation of the last decade. Think tech, think globalization, replaced by the structural inflation perhaps of the next decade. Think reshoring, capex discipline, energy, mining, all of the above, and tight labour markets, Tom. And that's the sticky inflation call that Ilarion was making with us just yesterday as well, looking ahead to next year and beyond.
I disperse it down to where Stuart Kaiser is. I think it's the smartest note I've seen in 72 hours
Over
from
Citi.
Citigroup. It's real simple. What you just said is a narrower group of successful companies. And it's not my job to pick those names, but fewer will win is where I am.
And it's not going to be big tech, which ultimately is the call that
Some
Savita's
big
making
tech
over
will
at B of
win.
A.
Some, by definition, somebody's got to win, but many
Sure.
will lose.
Well,
And I
Savita
don't
over
like
at
the
B
way
of
we-
A is making a point, Tom, that it's about outdexing. It's not about indexing. It's not about sitting there at the passive level in a market cap weighted S&P 500 because she just doesn't believe that tech's going to repeat the gains of the previous decade.
It's not our job to give opinion on this, but is this finally the year or the era where active begins to compete? That's the real question.
Ramo, how many times have we heard that?
I know. I struggle with the idea of what does active mean. Are you talking about just factor-based
That's
investing,
really
or are you
important.
talking about
Okay.
specific security selections? There's an issue with that. There's also an issue, though, right now with the idea that everything is getting re-rated with suddenly this idea that money isn't free, and that's a complete stock reevaluation if you see that stickier inflation. That has not been priced into the market. Right now, equities are expecting some sort of return to a low-rate environment, and a lot of fixed income is as well. And that is one of the biggest question marks of next year.
Mohammed said yesterday on the programme, we're not going back to it. We're just not going back to it. And the greatest message I got yesterday was that it's the end of free money, and it started with Japan and it ends with Japan. And that's why that move yesterday was so important. We're working our way out of 20 years of this, and we're seeing that happen in a big way in the last year.
You know, there was an article that I read this morning that when the Bank of Japan came in there to buy bonds, usually people are like, oh, here they go again with this. It was welcome this time because they were wondering when a buyer would actually step in because everyone wanted to sell at a time when there's a question about the need for yields to go higher.
I'll be quick here because we're not doing math today, but I want to be careful about active and R-squared analysis. I mean, the idea is an index fund's at 1, and if you're 0.92, you're a fake index fund. I'm looking at ARK Investments. This is worked out.
How's that getting
The
on?
R-squared is a 77.77. It's down 66%, 12 months trailing. So you got to be careful about treating all active the same.
Can I just tell you my favorite moment of the morning was when you said, while Lisa was talking, I was reading a note about something else.
I was listening.
I mean, come on, the research is coming in. We're still getting.
I was listening. That's what it's worth.
No, but the research is coming in real time this
it's
morning.
true.
People are working.
Are they?
Everybody but you, John.
Hey, Tom, I love my job so much.
You got your bags
this is
down
never
here.
work. This is never work.
God, you got
This is
the
a treat.
matching. You got the matching luggage.
But if the people signing the check are listening, I still want to be paid for this, of course, right expenses.
Oh my God, the sarcasm.
8:30 Eastern Time. This is a conversation you do not want to miss. The German finance minister, Christian Lindner, sitting down with Bloomberg's Maria Tadeo. TK, to your point, year's not over for the Europeans. There's a lot of work still to be done.
It is. It'll be an important conversation.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. A U.S. House committee has voted to publicly release Donald Trump's personal and business tax returns from 2015 to 2020. It caps a 3-year legal saga initiated by Democrats to obtain and release the former president's closely held financial documents. The vote comes in the waning days of the House Democratic majority and follows Trump's referral for criminal prosecution by another House panel. Now, federal authorities will whisk Sam Bankman-Fried to the U.S. to face a range of criminal charges related to the collapse of the FTX crypto exchange. Bloomberg has learned the FTX co-founder will sign a set of extradition papers today at a Bahamas court and take a non-commercial aircraft back to the U.S. escorted by FBI agents. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
it's clear that Bank of Japan is going to hike next year.
It's the end of an era, and investors have to get used to higher interest rates across the curve.
Eventually, this is going to bite. And inevitably, when the recession comes, spreads are going to widen further from here.
The global economy is likely to be heading into a recessionary path.
I think we're in a rolling recession, or we're going to get one. That's a dual cycle.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a year it's been. Live from New York City this morning. Good morning for our audience worldwide with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. This is Bloomberg Surveillance. Equity futures up 0.6%, recapping a phenomenal 2022. And TK, really, in many ways, it is the end of an era. The Federal Reserve delivering more than 400 basis points of rate hikes. The ECB going to places I never imagined they'd go to this year. And the BOJ to close out the year, TK. Joining in.
I haven't looked exactly at risk-free rate, but the bottom line is the end of the era for everybody in economics, finance, and investment. It's all the same story. Finally, there's a value to cash. There's a value to money. It is a return to where we were, I'm going to guess, 13, even 15 years ago.
It's the return of discipline.
Yes, absolutely.
The debate into next year.
You mentioned capital allocation.
CapEx discipline.
Exactly.
All of the above.
Yep.
And that's why the debate for 2023 is going to be over whether we can return to that pre-pandemic regime or not, or whether this, Lisa, is the new normal, or, as some people often tell me, it's just the old normal.
Well, this is, to me, the consensus that we are going to return to what we are used to in the past, that there won't be some massive re-rating in equities. This is, to me, the biggest question in 2023, because there are all of these issues, particularly with the deglobalization or the sort of re-globalization that's going on. I don't know what this world looks like and if stocks can really come out of a slump without some sort of sense of going back to a low-rate environment.
This speaks to the Fed pivot. If they do cut next year, what are they coming down to? What's the new level? Because what we got used to is you push rates up a little bit, back down to zero. That's how people started to think about the world. And Fed tightening cycles, they can only go up to 1, maybe 2. They've got to stop at 3. Tom and I were talking about this yesterday. Look how quickly things have changed in 12 months. We thought this year, 12 months ago, they were looking at a year. They had 90 basis points as their median dot for 2022. Rates are through 4. And you and I were sitting here and we were having this conversation with everyone in fixed income. Can we get to 2 without causing tons of pain? Can we get to 3? Can we get to 4? Now we're talking about 5, and some people are suggesting maybe it's more than that.
What will be the distinguishing feature probably will be wages. How much wages come down, how much you do see a weakening in the market. To your point, though, John, there are all of these inflationary impulses that come to the fore next year that are not there now, including the commodity sector, including with the reopening of China.
Equities right now on the S&P 500 up 5 or 0.6%. I'll whip through the price action. Brahma's got to go through the day ahead, the week ahead, if there's anything left to get through. In the equity market, we advance. Yields unchanged at 367.68. Are you upset that I'm finishing this year early?
You're using my vacation
Would you like
days,
to
but
come
that's
with
okay.
me? Aren't you off after this week as well?
I am. I'm off. And
okay. What are the plans?
Thrilled. The plans are to move children around.
Okay.
We have some joy in the house, and we're celebrating. One of the kids is making a movie.
You told me
which is
this.
very cool.
Congratulations.
It's years and years of work. I'm not going to go into the details and all that, but we're celebrating. We've got somebody singing jazz. We're celebrating.
But you can share that it is a Christmas movie.
I believe that the way you do this in Hollywood is to make a Christmas movie, because it's a really tough business right now, other than the big extravagances.
Are we going to do a whole red carpet premiere? And
I've already got my tux set for the Oscars. But
okay, great.
You know,
well, I'm looking forward
2
to
years
it.
from now.
Well, congratulations.
Yeah, we're like, we're
To a time.
regrouping. It's a Christmas regrouping
Awesome.
kind of thing. Unlike you.
We're regrouping too.
Yeah, the place you got has a moat around it, right?
It's a nice place.
It's got a moat.
I don't think it's not a castle with a moat, but it's a nice place.
Okay. Well, if the moat freezes over, you can skate.
There's space for you if you want to make it over and they kick you out.
We may do that.
Bramo, equities up by 0.6%.
John, I just want to clarify, you're actually inviting Tom to come with you on your vacation voluntarily.
Hey, you all remember the Thanksgiving we all spent together?
Yeah, that was lovely.
2018, Bramo, me, you,
all right.
Keene.
That was
fun.
Let's get through the day ahead. 10 a.m. November U.S. existing home sales are coming out, as well as December Conference Board consumer confidence data. Very curious to see what the deceleration is like in the housing market. When we look at what the Fed is going to do, how much does it hinge on how much we do see a softening in rents, a softening in prices? Today, Sam Bankman-Fried is expected to be extradited to the U.S., with the FBI escorting him back to the States. This then ensues the question around where his culpability is, given in all of the ire around the billions of dollars that he lost or that he perhaps misappropriated, according to the allegations of fraud from the U.S. government. And at 2 p.m., this really, to me, is the key event of the day. President Biden is greeting Vladimir Zelensky, the president of Ukraine, on the South Lawn of the White House. 2:30 p.m. press conference. There's going to be a discussion, the expectation of $2 billion of aid to Ukraine from the U.S., as well as the Patriot missile system, which is a defense system. But, John, where are the main tension points? Where are the red lines where it goes from defense to offense? Where is the room to negotiate into a harsh winter where everybody wants this conflict to end at a time of death and destruction and ongoing concern also economically for Europe?
Lisa, thank you. Big story for Anne-Marie down in Washington today. AMH is going to join us again, I think, in about 10 minutes' time. Big story in the last 24 hours for this market, the BOJ. This was Eric Nelson of Wells Fargo. He had this to say: dollar yen uptrend is likely over, more downside ahead. The yen's days as a no-brainer funding currency are likely numbered. Asset managers are likely to unwind short positions further over the next few weeks, driving dollar yen back to 125. This morning in the low 130s. Eric Nelson of Wells Fargo joins us right now. Eric, can we start there? How you think we have to rebalance as we shift away from this old regime?
Well, yeah, you've talked a lot this morning, John, and you and the team have talked about the end of an era and various products and various paradigm shifts here. One big thing that I noted there on the funding currency side, we've had a huge shift from the ECB, the Swiss National Bank, and the BOJ now this year. I think about those are really the three big funding currencies for carry traders in the FX market, and they've all just completely shifted on us. So this is really a warning shot here for carry traders. I want to focus on, it's sort of an arcane topic maybe for some viewers, but look at the cross between the Mexican peso and the Japanese yen. It's provided carry trade returns of 50% up until about 2 or 3 weeks ago. We lost about a quarter to a third of that in a matter of 2 weeks. So really, I think for 2023, the EM carry trade is really at risk here, and frankly, the G10 carry trade as well.
Peso yen, I'm looking here quickly, folks. Peso yen has gone 4 standard deviations, -2 to +2 in a cup of coffee. Is the dollar going to do the same?
Well, naturally, Tom, I think you'll see some unwinds in these yen crosses, and that's going to spill over to the dollar-yen exchange rate. Certainly, if you look at the asset manager positions in yen, they have been stickier, and probably up until now, we'll find out from the data next week. But to me, the question for dollar yen is getting back to 120 to 125 will be, I'll say, easy in quotes, in the sense that that's sort of like getting from, say, 7% to 5% on inflation. But what about from getting from 5% to 3% on inflation, or from 120 to 100 on dollar yen? And that's going to be the challenge.
That's the non-linearities here are unreal. Lisa, I just want to stop and say this is what the Bloomberg Terminal's about. We have a guest who talks yen peso, and I can bring it up in a cup of coffee. That's what the Bloomberg, that's why there's a gazillion of these Bloomberg terminals out there.
A lot of people are doing that and looking at some pretty phenomenal moves over the past 48 hours in response to this action from the Bank of Japan. You noted, Eric, that the action that they took does not necessarily show that that the bank is going to ease, just simply that they are willing to act in some sort of shift, but not necessarily a breakup of yield curve control. Given that's the case, what would it take for the yen to appreciate that much more? Why is there so much enthusiasm around the strength of the yen, the confidence of getting inflation under control, if this is just kicking up the target by 25 bips?
Well, Lisa, like I mentioned, there's the unwind of the carry trade, and that certainly can take yen to some extent. The bigger question here is, are we going to see a longer shift in capital flows from Japan? Japan, for 20, 30 years, has been a huge buyer of foreign assets, probably the biggest in the world. Question now is, if we have some real positive wage price dynamics taking hold in Japan, and we have some real increase in nominal rates here, is a substantial amount of money going to come back from abroad back to Japan? That can drive that move from 125 or so down to 100. But crucially, this relies on inflation in Japan continuing, growth remaining quite strong, and the BOJ at least providing a little bit more upward lift in those nominal yields.
So, Eric, where are you looking for that? Where are you looking for Japanese demand that supported European bond markets for sure over the last few years, and the Treasury market? Where are you looking for that to wane?
Well, yeah, John, you mentioned U.S. and European bonds, and look at the hedged yield on that. When you swap these returns back into an yen, it's really a brutal picture for Japanese investors buying U.S. Treasuries, buying French bonds, and so this really accelerates that trend of probably net selling of Treasuries and French bonds. You certainly have to also watch for some asset-backed products in the United States, where Japan has historically been a pretty big presence. So that's really where I'm focusing my attention.
Just to wrap things up, big picture, Eric, I was speaking to Jim Caron and Morgan Stanley just yesterday over the Bloomberg, and I'll catch up with him a little bit later this morning. He's asking the following question: the second-order effects of markets leveraged to low and stable yields. Mohamed Al-Arian brought that up yesterday as well on the programme. Eric, can you tell me what you think those effects will be as we shift away from this regime, leveraged to low and stable yields for much of the last 10 years?
Well, John, I think central banks really need to be careful here. And this comes back to why the BOJ has sort of couched this move as not a tightening of policy, and there's not more to come. They've increased their buying of JGBs because they know just how fragile the BOJ or the Japanese system is and how leveraged it is to low yields. So you certainly have to watch some of the Japanese banks and their exposure and duration risk. I think the bigger point here, though, John, is central banks. We talk about the end of the central bank put in the equity context. What about the bond context? Yep. Nearly every central bank is doing quantitative tightening next year. They're hiking pretty aggressively. We've really never seen this environment before, especially given our starting point. So got to really watch out for long-term bond yields in 2023.
Hey, Eric, this was wonderful. Thank you, sir. Eric Nelson there of Wells Fargo. Really nuanced, deep conversation, Tom, about what we might experience over the next 12 months.
Yeah, the parts here, everybody focuses on interest rate relative analysis, and maybe next year is a time to look at flows, the huge money sloshing around. And of course, the bet is a lot of that money returns to Tokyo and Japan.
The S&P 500 futures right now up almost 0.5%. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. A prominent research group says Brexit has left the UK economy 5.5% smaller and added to the squeeze on public services. The Centre for Economic Reform says slower growth is also weighing on the Treasury's revenue and that the tax increases announced in the autumn statement wouldn't be necessary if the UK was still in the EU single market. The findings are the latest to highlight the costs of Brexit, which is limiting Prime Minister Rishi Sunak's effort to pull the economy out of a recession that may last until the next election. Ukrainian President Volodymyr Zelensky is expected to travel to Washington today to meet with President Joe Biden and also address Congress. The speech will follow an expected move by the Biden administration to announce the delivery of Patriot anti-aircraft missiles to Kyiv, ratcheting up U.S. support. Chinese President Xi Jinping has told former Russian President Dmitry Medvedev that his nation would like to see talks on Ukraine. The remarks come as Beijing tries to improve ties with Europe. State broadcaster China Central Television is reporting Xi told Medvedev that his administration has been actively promoting peace and talks. China has avoided criticizing Russia over the war in Ukraine. And France is bracing for another Christmas of travel disruption after the state-owned railway operator SNCF was forced to cancel 1 in 3 high-speed trains because of strikes. Air France also faces possible strikes in the coming 2 weeks, although the airline has pledged to take all its clients to their destination. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
After a long process, that this was not about being punitive, it was not about being malicious.
After nearly half a century, the political enemies list is back in Washington, D.C. And we worry this will unleash a cycle of political retribution in Congress.
More tension in D.C. How many times have we said that over the last 10 years or so? In fact, Tom, over the last 50, maybe plus years. Representative Richard Neal of Massachusetts and Representative Kevin Brady of Texas there. Live from New York, your market looks like this. The equity market with a lift on the S&P 500. Equity futures advancing just a little bit here on the S&P, up by 0.4%. Yields unchanged on a 10-year. No drama. I have to say, no real drama yesterday in global markets off the back of what Japan did, which was maybe a story in and of itself, Tom. Euro dollar right now, 106.07. Euro dollar negative, about 0.1%.
Somebody said that. Why is it discrete and why is it separate? And I said it's big macro international economics. It'll have ramifications over months and years, as we heard from Dominic Constant and others, Dr. Alarian in your hour. And John, it doesn't have to move the markets. I just don't agree. People were like, well, why doesn't it move the markets? I'm like, well, so what? It's just a big central bank move.
It takes time.
It takes time.
I keep saying it takes time. They're still conducting yield curve control. They've just shifted the range. There's a new upper limit. It's 50 basis points.
Sterilized it is my point.
We're getting to that point this morning, getting closer to that level, and there are some people who think we're going to test that level. What was interesting to me about yesterday, and we mentioned it on this program, some of the firms who were short JGBs waiting for this to happen, Schroders, I think UBS were another.
You mentioned Blue Bay, I believe.
Yeah, Blue Bay too.
Yeah.
Blue Bay and Schroders are sticking with the short. I thought it was interesting because usually you'd see a move like that, you close it, new level. They think this is going to see, cascade. You're going to see several steps of this through next year.
I can understand why. At a certain point, if they are dealing with inflation, if they're dealing with a new head of the Bank of Japan, you have to imagine there are going to be some other moves to come in the next couple of months.
In the zeitgeist, I'm not up to speed on domestic Japanese inflation, but there is a feeling it could move higher from here. I'm not predicting that, but at 3.7% as a nationwide number, can it even ebb higher as well? And that would create even more tension.
If Governor Kuroda leaves in April and inflation's got a 3 handle, wouldn't you have called that a success 8 years ago?
Yes, that was his goal.
Wasn't that the objective?
That was the objective, but not for these reasons and not with a debt buildup that they've got as well. We'll have much more on this. Right now, we've got a double barrel with Anne-Marie Horton here, stunning visitor to Washington today. We'll pick up on Mr. Zelensky here in a moment. Anne-Marie, I've got to ask about the taxes. I mean, I fill mine out on the back of an envelope and throw them in, and that. What do his taxes even look like? Like, how many pages is a fancy real estate guy who's president's tax return?
Well, you can actually see how many pages because there's been lots of reporters waiting outside the committee's door as lawmakers were set to gather yesterday to talk about Trump's tax returns. And it was 2 huge, basically wheelie trailers filled with papers. But we, the Americans, will be able to see them in the coming days. One's personal information like Social Security numbers are redacted. The House Ways and Means, this committee set up, led by Richard Neal, they are going to be releasing Trump's tax returns.
Right.
What we found out yesterday from the report is that they say the IRS did not sufficiently or did not at all audit the president, and they're pointing to a number of potentially dubious charitable claims, some questionable jets, gifts to his children, and the fact that there was deductions that there should not have been.
And for those of you on Bloomberg Radio, I just want to note that the firewood that just went by behind Anne-Marie Horton is the president's gift to AMH for the fireplace at the manse this year. Anne-Marie, the heart of the matter right now, and Tim O'Brien, who's truly expert on this at Bloomberg, going back decades, is the IRS that, as a generalization, we're missing in action. Will that receive immediate scrutiny, or is that something for January?
Well, the report said that there was actually only one person dedicated to this. It's not going to be immediate, of course. You have a very busy week in Washington, and these individuals, what they call the jet fumes, Tom, in Washington, the lawmakers start to smell the jet fuel and they want to get out for the Christmas holiday. This will be picked up next year, and clearly this will be interesting because you're going to have a divided Congress and the Republicans may not want to pick up this baton. But what Richard Neal, the chair of the committee, is pushing for is that when you have an elected president, the first 90 days, the IRS should be going through their tax returns.
The fact that you talked about the jet fuel and they're smelling it as they prepare to go home is possibly the reason why Vladimir Zelensky is coming to Washington, D.C. to make sure that Ukraine is very much on the agenda heading into year end at the start of 2023. How receptive are Republicans to that message?
Well, it depends which Republican you ask, right, Lisa? We've heard from Mitch McConnell, who says that he wants to continue that support for Ukraine. Interesting, this week, we did see Secretary of Defense Lloyd Austin up on the Hill going into Mitch McConnell's office. All of this before we have President Zelensky making this really shocking and unprecedented trip. He has not left Russia, and he's coming to Washington, D.C. in this plea, potentially to Senate Minority Leader Mitch McConnell's colleagues on the House side. We already heard who is expected to be Speaker of the House, Kevin McCarthy, say that there will not be a, quote, blank check to Ukraine. You have individuals on the fringe side of the Republican Party who are even being very disparaging about Zelensky. Marjorie Taylor Greene, representative from Georgia, calling him a shadow president. And really being disparaging about his visit to not just the White House, but when he's going to make that joint session this evening to Congress. So this is Zelensky's plea in person. They're coming up on a really harsh winter. Putin has already been trying to use that winter and try to knock off power lines, heat, water for Ukrainian people. And he is here to say, you know, we will do the fighting and continue, but we need your help.
When we talk about end-of-year agenda items, how much is oil on the agenda, given that oil prices, gasoline prices have come down, but there is going to be a cold snap. You do see diesel prices still elevated, and there is this question about what happens when this administration starts refilling the Strategic Petroleum Reserve. What's the scuttlebutt in D.C. on that?
So one thing for certain is that it's a very early Christmas present for this White House. You know, Ron Klain, the chief of staff, is obsessed with gas prices, and they are poised to drop below $3 a gallon nationwide. But Lisa, what you are talking about is diesel. How do you heat your homes? That is going to be the more critical crisis this winter. Not gasoline. We are already over peak driving season. Prices are coming down, but heating oil, especially out west. So this is about liquefied natural gas. And this is not just a problem for the United States. This is a huge problem in Europe. Just this morning, Maria Tadeo sent me her energy bill. It is 3 times her what she normally pays. This is going to be the biggest problem facing this winter, LNG, not gasoline.
Yeah, but tell them what you actually said, because today I sent it to both of us, and do you know what AMA said back to Maria? Quit smoking. That was the response from AMA to Maria, just blunt, brutal, save some cash, quit smoking. Anne-Marie, thank you. Over in Washington, D.C., we'll catch up in about an hour from now.
Maria and
AMH is brutal.
She's
today.
brutal. In Brussels,
just, you know.
Maria and I go to that. There's a cigar bar.
You know?
There's a cigar bar right along whatever the road is. I don't know what the stretch is of leafy treed Brussels, diplomats shopping and that. Maria and I go to a cigar bar there. It's great. You know, it's you know, she's a trooper. Can I point out, with the cold coming on, for those of you international, we're going to have massive cold, I'm going to say as a generalization, from Montana to Ohio. In Lisa's Fargo right now, John, we go to centigrade here, folks, for John Ferro, minus 26 degrees C.
Centigrade? Wow.
Right now.
Wow.
Yeah.
I've experienced that lower than that only once, Lisa, Plymouth, New Hampshire.
It was 30 degrees below 0 Fahrenheit when I was there for a full month. My car died. You know, you learn
your car,
that if you don't plug it in, your car dies. And you know, you can't write with pens outside. If you're a reporter taking notes on a fire,
you're a journalist out there.
You need to use a pencil because the pen freezes. The ink in the pen freezes.
This was your investigative reporting days.
It was, yes, correct.
In the winter.
Correct. I found out quite a bit.
John, I've been in hockey games where the game is canceled because the skates won't work.
Oh, really?
Skates work with a stream of water underneath the blade, and if it's so cold, there's no water there, and it's like this. Of course, wait, I skated like that anyways.
So basically, you're saying New York is not cold right now. That's like your shtick.
You whining about the cold.
You know,
you're winding yourself up.
That's his shtick.
It's so tourist.
Tom, as a man who appreciates and respects science, what is freezing? Snapped a 4-day losing streak on the S&P 500 in yesterday's session, just about, with a small day of gains. Greg Peters of PGIM joining us around the table. You might be able to hear him chatting with TK. That's why I'm throwing that out there.
It just keeps going.
We'll get to Greg in a moment. In the bond market, Greg's a TV pro. He knows what he's doing. He's just trying to distract me. In the bond market,
oh yeah, it's Greg.
Treasuries look like this. I wouldn't call it. It's TK TV Pro.
Just carry on. Market check. Let's go on.
It's a philosophical question.
What is freezing? Your 10-year right now, 368. Your 2-year, 422. Let's call it 423. Yields are lower at the front end by 2 basis points. We caught up with Wells Fargo in the last 30 minutes. I've mentioned this call from Mike Schumacher a few times, who still thinks this 2-year can get back into the high 4s again over the next several months. Want to finish on Japan, Tom? Just look at the Japanese 10-year inching back to that new threshold, that new upper limit of the new band over at the BOJ, which is 50 basis points, Tom, right now, 48.
Got an email. Forget the centigrade. What's Fargo? Minus 14 degrees. International Falls, John. When we were kids, you would always check International Falls, Minnesota. Minus 25 centigrade right now.
Was that because it's the coldest place in the country?
That's Fahrenheit. Minus 32 centigrade.
Okay.
Yeah, it's usually releasing, that's like when you were kids, that's what you looked at.
I'll just say, in fairness to John, in New York, you actually walk around. In Fargo, you have your car heated, and then you run into your car.
And you're in tunnels.
And then you're in tunnels in Minneapolis.
Yeah.
So you don't actually walk outside. So it does feel colder in
Very
New
true.
York when it's less cold because you actually are in said cold rather than behind closed doors.
Or if you're in LA and it's 52 degrees, the women are in furs. There's that whole crazy
What's
thing.
that about?
I don't know. That's what they do. Greg Peters is like, why are we here? What do we got? Individual names? What
All right.
doing,
I'll
Lisa?
just do this really quick.
Talk about single names.
No, I think I just want to reiterate what we saw from FedEx, Nike, and some of the others that we got earnings from. If you take a look, flying in terms of pre-market action, FedEx shares up more than 4% after better than expected earnings, and this really does come from the ability to cut costs and increase their charges on each package. Because what you're seeing at FedEx is lower volumes. I think this is interesting. This doesn't necessarily mean that we see a very robust recovery in the economy, just that there still is pricing power at companies. Nike shares up more than 11%. Sales rose globally 17%. This is an issue of a company that still has a lot of inventory but can sell them with pricing power because a lot of kids like Air Jordans, I'm just saying theoretically. And after the bell, Micron is reporting earnings. I'm very curious to see whether there is some sort of snap in the downtrend that you've seen in some of these semiconductor stocks.
Are you stocking a load of Nikes at Casabramo?
Absolutely not. Is that the desire?
What's happening with the
among
youngest
some
right now?
people?
Is he trading them, or is he just, what's he doing? Does he buy them to wear?
We're kind of moving past that phase. I think that was a phase.
Oh, it was a phase. He's not into it anymore.
Well, we had a situation with mud with one of them, and it sort of killed the cleaning environment.
So what's he going to do? Is he going to sell them?
I don't think he can at this point. I think that we had a situation where we got stuck in a little bit of mud, and the Air Jordan
they're
is
ruined.
devastated. Yes, correct.
And is he deeply upset about it?
Let's move on.
Are you going to replace them?
Let's move on.
Is he watching now?
If he gets older, he can replace them himself with his gifts.
Sounds like divorce arbitration.
I was told this morning Santa is going to get you a brand new pair of those Nikes
Oh my
you want.
Let's move on.
Just
Happy
just trying
Hanukkah.
to add that.
Are you going to do something here?
Yeah, actually,
okay,
we caught up with
please,
Mohammed
jump in.
yesterday. Alarin on the BOJ had this to say. Take a listen.
There's no doubt in my mind that this is the step towards normalization, but they're trying to make it a really long process, as unexciting as possible, so that it doesn't force selling by Japanese institutions. That's the big risk.
That's the risk going into next year. And the question we were asking just yesterday after the shift from the BOJ, was that a step towards normalization? Or was it just about setting policy on a more sustainable path to maintain that dovish stance, but making it more sustainable? Overwhelmingly, the response to that question yesterday was former, not the latter.
Yeah, and my basic take is they blinked. I mean, that's all there is to it. This is a joy, and for Global Wall Street, you can take notes right now. PGIM is prudential, and when they set up PGIM and resurrected it a good number of years ago, no one could expect the total return award-winning portfolios they put together. The force behind that, the thinking behind that, was dragging from Morgan Stanley Greg Peters over as co-CIO, and he joins this morning for a fixed income brief. Greg, I'm going to cut to the chase. You call for a radical shift next year. Where will that shift be?
Yeah, so I think the shift is in the bonds. So this year has been historically difficult, to state the obvious, but yield matters and starting place matters. And so if you think about just the BOJ yesterday, right? We've moved from this zero to negative interest rate policy to pretty sizably positive territory for yields. And that matters a lot. Like when we were looking at the 10-year at 50 basis points, our future looked really pretty bleak, right? It was hard to kind of earn total return and return off of that. But where we are today, I think we're in a much better place. I think it creates much more balanced portfolios. Those who were calling for the death of fixed income were kind of right for the year. But I think the reset matters a lot. And so we're pretty constructive as we head into 2023.
Is this a call on sovereigns, a call on credit, or a call on the whole universe?
It's a sequencing of sorts. So I think the first move is on the sovereign side. So the defensive nature of fixed income starts to assert itself. It seems like there's a high probability of a recession. Who knows? I think it's very bimodal, and so it's really difficult to ascertain. But I think that protection mechanism matters a lot into 2023. And then I think you roll into credit and other things. So I think it's a sequencing aspect of fixed income that provides different flavors of protection at different times throughout the course of the year.
Does that sequencing rely on inflation disinflating? If there's a sort of gradual and linear path to a lower level for inflation, does it have to really happen that way to make what you're saying come true?
It does. I mean, I think the lesson of 2022 was stagflation, bad for all financial assets. Even commodities started to catch the knife for a little bit here towards the end of the year. So I think as we move off the stagflation narrative, I think it bodes much more favorably. If we're wrong around that, and inflation is incredibly difficult to forecast, of course, but it does seem like all indicators point to lower inflation in 2023. I think the tail risk that we were experiencing in 2022 gets chopped off in 23, and I think that matters a lot.
Although if you do see a stickier bottom, right, let's say we stop at 3.5% by the end of next year, how does that leave your call, considering that some people are talking about structurally higher inflation, given some of the labor market dynamics, given the gaps there, and given the deglobalization that a lot of people are talking about?
That's a clear risk, and I think that is an underappreciated risk. That said, go back to starting point. So do we think the Fed is going to move another 400, 500 basis points from here? No, right? So we're talking about now incremental. I do think the markets are wrong in terms of the pricing where the markets are pushing back on the Fed staying higher for longer, and I don't know if I buy into that myself. I think we are in this higher Fed rate regime, but that in and of itself isn't a bad thing for fixed income assets where it's about roll and carry and yield and income. And so I think it bodes quite favorably.
Percolating is in the equities space, maybe international with weak dollar, with what we saw with Japan yesterday. International finally has a day after 10, 12, 15 years. What will international bonds do? Do they outperform price up, yield down?
I still think the preferred habitat is in the U.S. I think Europe has their struggles, of course. They're fighting a different inflation monster, right? It's a shock, right? The energy shock, very different than what we've seen here in the U.S. I think the U.S. is, much more on the path of normalization. The BOJ yesterday, I think, was a shock to the system in that it creates volatility that doesn't induce investment. It induces exit, right? So I think by virtue of that, the U.S. is the preferred place to be. And then if you buy into this weaker dollar story and inflation coming down global story, then EM has to outperform in that scenario.
Are you expecting that spread between US and Europe to close? US yields lower, and then actually get European yields creeping higher? Is that how that spread's going to close?
I think that's right. But I think on the margin, you'll see a bid to the U.S. market, and I think Europe and sterling in the same boat, where there's a tremendous amount of supply hitting the markets in 2023. There's a clearing level there. There's lots of government spending. And so I do expect things to compress into 2023.
Europe's in for a difficult time. That's for sure, Tom. Not just the UK, the whole of the continent going into next year again. To see these numbers coming in from the ECB, that delivery from President Lagarde, I was shocked by it last Thursday.
I'm in the camp they don't have the nominal GDP to make it work sort of like Japan. They're better than Japan. Some people disagree with me on that. They think the nominal GDP is robust. I would look at Patriot missile announcements today in Washington is linked directly into Lagarde theory.
We'll catch up with the German finance minister at 8:30 Eastern time, so about 50 minutes from now, sitting down with Maria Tadeo. Do not miss that conversation on TV and radio. Have you seen this quote from Torsten Slok?
Yeah.
Apollo, what do you make of that?
Well, this is the detail that made him acclaimed at Deutsche Bank. I remember hanging out with him at Davos, and when Torsten Slok speaks, fancy Davos people stop and listen.
For those on radio, labour demand, 5 million people higher than labour supply, which is why wage inflation is so strong. He goes on to say the solution to the imbalance is either to increase the labour supply, for example, through higher immigration, or to lower labour demand, for example, through an increase in the unemployment rate. Greg Peters, it looks like we're leaning on the latter pretty hard, doesn't it?
It does indeed. It does indeed. And so this is I think, the tricky part of the marketplace and why I think it's a bimodal outcome, right?
Yeah, do you know what's amazing here, Greg? They're over in Jersey City. It's so cold in New York, Johnny. He walked across the Hudson River this morning, skated across.
Oh, skated across.
Yeah, it's like a Dutch thing.
Used to be able to do that in the Victorian times on the Thames.
Yeah.
Do you remember that?
I don't remember that in Victorian times. No,
Greg,
no.
good to see you.
Greg, it's that cold,
it's
John,
just a
in New
little
York.
bit of festive humour that was, Tom.
That was very festive,
You guys have to lay off the eggnog so early in the morning,
Well,
don't let our secret out here.
Why are you telling people that so publicly? Just a little, what do they call that? You call that a festive tipple, right? Just a little drink.
That's pretty.
Did you see that Christmas song that someone sent to us? I'm going to get someone to get that from my desk. Did you get that?
No,
someone
didn't.
mailed me a surveillance countdown to Christmas song.
Oh, really?
Yeah.
My people didn't show me.
No, I'll get someone to run over to my desk and bring it out.
You're one
Greg,
of
this
the
was fun.
interns.
Thank you.
Thank you.
Thank you. Thank you very much. 8:30, as I say, Christian Lindner, the German finance minister, sitting down with Bloomberg's Maria Tadeo, a conversation you do not want to miss. We're joking about the year being over, but seriously, in Europe, the year's not over. There's so much work to do going into 23.
Yeah.
Without a doubt.
Absolutely.
Futures right now on the S&P elevated, up by 0.5% on the S&P 500. Yields are coming in just a basis point or two on a 10-year, 366.38. Euro dollar really not doing much, unchanged at 106.25. And crude, what a trip it's been through 2022. 77.77 on WTI.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. A U.S. House committee has voted to publicly release Donald Trump's personal and business tax returns from 2015 to 2020. It caps a 3-year legal saga initiated by Democrats to obtain and release the former president's closely held financial documents. House Ways and Means Chairman Richard Neal says the documents will be out in days.
After a long process, that this was not about being punitive, it was not about being malicious.
Now that vote comes in the waning days of the House Democratic majority and follows Trump's referral for criminal prosecution by another House panel. Federal authorities will whisk Sam Bankman-Fried to the U.S. to face a range of criminal charges related to the collapse of the FTX crypto exchange. Bloomberg has learned the FTX co-founder will sign a set of extradition papers today at a Bahamas court and take a non-commercial aircraft back to the U.S. escorted by FBI agents. Elon Musk says Twitter was on course to hit $3 billion of negative cash flow prior to the recent round of severe cost-cutting. Musk bought Twitter for $44 billion in October. He has drastically cut costs, including laying off more than half of Twitter's staff, and has since confirmed he stepped down as the chief executive officer on an appropriate replacement is found. And Afghanistan's Taliban-ruled government has barred women from attending universities and is enforcing the order at gunpoint in some places. The Minister for Higher Education announced the order suspending girls' education until further notice, saying it isn't an Afghan tradition, but rather part of Western culture brought to the country during the presence of U.S. forces. Global news 24 hours a day, on air and on Bloomberg Quick Take.
It's a self-fulfilling prophecy. When everyone talks about the economy slowing down, that's when it happens. One thing that has been very missing is any sort of job loss. And this is something that I want to make crystal clear. When the job losses start to happen, that's the recession. Multiple quarters of payroll losses, is the start of the recession. It's like the weatherman standing in the rain saying, I think it might rain.
We've got a weatherman right here. He's giving you the weather every single day. TK, how cold is it in Fargo?
Minus 14,
Thanks for
minus 17 or 18
That
in
was
International
Lara Rain
Falls.
of FS Investments, the
Yeah.
chief US economist.
Yeah.
Multiple quarters of payroll losses is the start of the recession. It's like the weatherman standing in the rain and saying, I think it might rain. That was Lara Rain. That's a great quote, actually, isn't it? And it's fantastic. If you're just tuning in on TV and radio, here's the price action for you on the S&P 500, up by 5 or 0.6%. Yields coming in just a couple of basis points. No real drama here as we close out the year. The 10-year, Tom, 366.
The drama was from Lisa Abramowicz, and that was Federal Express and Nike. I don't think it's a small issue. I think that, we're in the holiday season and we're ignoring it. I'm sorry, if this was July, whatever, this would be
Well, Lisa
top
framed
of pile.
it. Lisa framed it in
Top
the
of
appropriate
pile.
way. What's the macro signal? Maybe not a great one, but the corporate signal is they're adapting to it. So if you take a look at FedEx, what did they do? Put prices up, cut costs, but volumes down. So that's your signal for the economy, but for the stock, for the company, maybe okay. For Nike, same thing. Sales holding up pretty decently, but inventory going in the wrong direction.
Pricing power. How long do companies have it? And that, I think, is really the issue as volumes come down. And when you see these companies have pricing power, is it specific companies that are consolidating share? Or is this a broader sense that consumers have strength that can continue inflation even as the economy slows?
I've made clear to me it's the great zombie roll-up next year. And the other side of that is few will win. And the Nike numbers today I thought were stunning. This is a joy right now. Gina Martin-Adams joins us to say she's chief equity strategist at Bloomberg Intelligence. Doesn't describe the reputation on the street. She was one of those people who said you have to be in the game to win, and the idea to dash to cash is anathema to her. She joins us right now. Let's recalibrate through your team of strategy and the individual securities analysis on the street and at Bloomberg Intelligence. What is the earnings call or the vector right now of an earnings guess for the quarter?
Yeah. So I think a lot of the earnings outlook also depends on where you've been. And I think we want to acknowledge the fact that earnings peaked a year ago. Earnings ex energy on the S&P 500 peaked at the end of 2021. It's very little, there's little acknowledgement of this. So we've been in an earnings cycle deterioration already for a year. We see that cycle deterioration getting worse, but looking nothing like anything of the last 3 recessions, which creates a lot of complexity for the investor base, because I think the natural recency bias says, okay, look at 2020, that's probably not relevant. But then look at 2009. That's our most recent example of what a recession looks like. There is such little chance that the recession ahead looks like 2009 or even looks like 2001, because the economic excesses today are not like those that existed in 2008 or 2000. And I think that that's creating a lot of challenge for investors that are thinking about what's ahead for 2023. The reality that we see is a slow burn on the earnings stream, which is so painful. It's been what we've been through 2022. It's probably going to continue to persist into 2023. But it is an earnings contraction. It's a shallow but extended earnings contraction, which is really difficult for the investor base.
Do you
to contend.
suggest across sectors that there will be a few that win while others struggle?
Absolutely. And that's been the case this year. This year, very clearly, energy's been the dominant winner. We've had massive dispersion in performance as well as earnings trends at the sector level, where financials, consumer sectors have struggled tremendously this year. They will probably actually bounce back into 2023. Where energy has been a big dominant driver of earnings growth this year, we will see earnings contract for the energy sector next year. So there is a lot of dispersion in the earnings stream. Technology is a huge area of controversy right now. Remember, tech earnings have been contracting as well in 2022. Tech earnings will likely stabilize into 2023, as these are the companies that have been cutting costs the fastest. You know, all of these job losses that we're reading about and hearing about in the tech sector are probably going to create some sort of margin stability for tech in the first half of 2023 that leads to improvement into 2024.
There's a question about the dynamic of an earnings decline. Does it come from margins compressing, or does it come from an ability and inability to keep passing along the costs and really just the slowdown in overall volumes, right? I mean, these are two components that have a very different profile when it comes to the economy.
Yep, and I think that that's been part of the conundrum of 2022 is the earnings recession of this year looks so very different than the recessions that we've become accustomed to, because the inflation environment is so contrasting to that of the last 20 years. We've had remarkable acceleration in inflation, which has played out actually through deteriorating pricing power for the vast majority of S&P 500 companies throughout 2022. With the exception of energy, you're seeing operating margins compress across sectors on the index already this year. What we see happening into 2023 is deceleration in volume sales, but probably some stability emerging on the margin lines. Again, completely contrary to what we've experienced in the last several recessions, which really inflation and growth moved hand in hand throughout the last 20 years. That's not been the case this year, and I don't think it's going to be the case next year. We're going to continue to see inflation decelerate. Growth will probably continue to decelerate with inflation, but at some point, inflation will decelerate enough to create some stability in margins. Completely different than what we've been through for the vast majority of our recent history.
So is this positive?
I think it is ultimately positive, but it creates a lot of volatility in the short run. Certainly, operating margins tend to lead the earnings stream. So if we can get some stability in margins over the course of the first half of 2023, it should lead to some improvement in later 2023, 2024. But this has been the most forecasted recession that I've experienced in my lifetime. We've been talking about this recession coming for more than a year.
No.
We've been waiting for that downdraft in revenues. So analysts have actually started to forecast this in their earnings lines. I would not be surprised to see by the second half of this year, we're all surprised by how little of a recession in earnings we experience.
Is any of the last year or the guesstimates forward in Graham, Dodd, and Cottle? I mean, is anything of traditional security analysis, edition 1, edition 4, edition 8, whatever, does any of that really matter coming out of this pandemic?
I think it does. Certainly, we have seen a very close response to price action relative to interest rates. Very clearly, valuations respond to interest rate changes. Valuations were enormously high when interest rates were at zero and the Fed was completely reinflating all asset prices. Valuations compressed remarkably over the last year. We've had enough valuation compression since the end of 2001 to match the 3 years of valuation compression we had from 2000 to 2002, for example. Wow. So really extreme reaction in the market related to interest rates. Earnings, likewise, I think we just have to acknowledge the fact that corporates are incredibly quick at adapting to the economic climate. And we saw this morning. You highlighted it in your notes before I started speaking. The corporations are very quick to
Lisa
adapt.
Did. That was all Lisa.
It's always Bramo.
Thank you, Lisa.
Bramo's the only one that says anything sensible
Lisa.
here. It's just
the
a fact.
economy and the earnings stream are not the same thing. And I think this is another disconnect that investors really struggle with. The economy is a slow-moving machine. Corporate earnings do reflect the economy to some degree, but it is not the same thing by any
St. Martin Adams is killing it.
You're shedding a tear.
Just
Gina, how do you
killing it.
feel about the outlooks? The outlook season. You've done this a million times.
Yeah.
How do you feel about it?
Oh, it's next to impossible to predict where we're going to be in the next 12 months.
Come on,
right?
they're just marketing
You can get
books.
some degree of anticipation for the next 3 to 6 months, but you have to impute some sort of historical analysis into your expectations. And I think that this is the biggest struggle this year.
You pop 55 pages out and they say, hey, you're going to get 150,000 frequent flyer miles out there. You'll love O'Hare, right, in a snowstorm.
Yeah, I mean, it is a business. It's a business
It
for
is a
reason.
business.
Is it a useful exercise, though? Just a thought exercise for you? Do you find it useful?
It's a thought exercise. We go through it quarterly, right? We don't just do it at the end of the year. Every quarter we update our thoughts and we think about where we think the market is headed, where we think valuations and earnings are headed for the next 12 months based upon a run rate of economic history compared with a forecast for where we're headed. But I think that this particular period is so difficult because of what we talked about earlier, where the inflation dynamic is just frankly different than what most of us have lived through.
Multiple compression, Apple's crushed down to a 21 multiple.
Well, asking what multiple should be on
say.
Apple has always been an interesting question.
Yeah.
And I think it is again as we close out the year. Gina, thank you.
My
This was
pleasure.
wonderful.
Thank
Just
you.
awesome. Thanks for coming in. Gina Martin Adams there of Bloomberg. Your equity market, Tom, up 0.6%. Just a little bit of a lift here going into the opening
But
bell.
is that lift because of FedEx and Nike? I would say so. I'm sorry.
Look, the fact
those
that
are big
FedEx
numbers, and the way they did it, they're clearing inventory.
The fact that FedEx didn't do a September repeat, I think is good news, because what they said in September That sounded like the start. Remember then? That sounded like the start of the global recession. It was like, they came out with that statement. I remember Deutsche Bank, I think, called it the biggest miss they've seen in 20 years.
And it was really a reflection of the broader economy. I can just say, it's not like there's a screaming enthusiasm in this market today. There's
Bramo,
a
can I just say,
kicking it around.
Before I disappear for year end, thank you for always being sensible on this show.
Aw.
Just for making
Are you
it the
done
serious
now?
program
Are
it
you
is.
leaving now?
No, I've just got a lot of thanks to fit in, and I've got 20 minutes to go. All right?
Thank you
David
for
Kotop coming up next. Just for being here and being me.
Yeah.
Yeah? Thanks.
The global monetary tightening train rambles on.
Central banks are going to be pushing higher for longer, and I think that really drives the direction of markets over time.
The Fed is not going at it alone.
The biggest risk would be that the Fed gave up the 2% target, and we just don't see the path for them to do that.
It's a self-fulfilling prophecy. When everyone talks about the economy slowing down, that's when it happens.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television, staggering into 2023 after an historic day yesterday and follow through today as yen continues to strengthen. John, we've got a number of different stories here looking into next year. We'll do that with David Kotak in a minute, but the answer is FedEx and Nike show that you can adapt and adjust, as the Bank of Japan did yesterday.
Well, companies adapt, and the good news, and we talked about it briefly in the previous hour, is that FedEx didn't do a September repeat where they kitchen sinked it and said how terrible things had got and how quickly that had happened. Looking out to next year, we need to talk about the price to pay for a major tightening cycle from the Federal Reserve. We've seen the market price to pay. The scores are in. It's almost full time, and the S&P 500 is down about 20%. The Nasdaq's down about 32% year to date. So that's the market pain we've seen. Now we need to talk about the economic pain. Where's the threshold?
Right.
For this economy? Is it 4%? Is it 4.50? Is it 5%? Do they go further than that at the Federal Reserve?
I was just looking at this moments ago before we were coming on in this hour, folks, and I'm looking at a 1 year trailing crater in the Nasdaq down 30%. But the others to me are pretty good. And the answer here, John, is it's about profit. If you're not making money, it was a really difficult year.
It's also about multiples and the valuation that we assign to some of these names with zero interest rates. We've got the discipline of 4, the threat of 5, and I talked about the performance of some of the major companies. I'll keep going back to it. It's not just Tesla, which we talk about every single day at the moment. Meta's down 65%. Amazon's down almost 50%. Alphabet's down 38%. Microsoft's down 28%. And Apple's had a really tough December. Apple's down 25%.
That's an international story as well, and that's
We're
China.
going to find out. Have we got a supply problem or a demand problem? We've been asking that a few times, haven't we?
That's the debate. And Lisa, the debate centers around, off of Japan, China as well. We didn't link enough China and Japan yesterday. That is the major mystery into next year, is this dominant economic partner.
There were 2 sleeping tail risks coming out of Asia this year. It was China reopening. It was Japan dropping their yield curve control, both of which look like they are probabilities heading into 2023, and markets are not disrupted right now. This is one of the big mysteries. Have we gotten over that hump? What is next year's tail risk, or can we not even see it yet?
I look at this, John, and first of all, I want to say yesterday's coverage of this news out of Japan, and particularly thank you to Mizuho for having Dr. Constant come on. Constant and Steve Rasciuto was on as well, I think was great. But the follow-on here, John, the message that I'm getting is you can link that Bank of Japan shock and follow-on into some of the optimism out there. And I believe we have Neil Dutta in this hour, which is important.
It's getting harder and harder to try and control your bond market with yield curve control. The 10-year in the US, in the UK, in Germany, year to date, up more than 200 basis points year to date. Before the move yesterday from the BOJ, the JGB, the 10-year, had done nothing. It wasn't even up a single basis point on the year. Right. It was increasingly unsustainable to try and maintain that yield curve control. I'll keep going back to the question we have to ask going into next year. Is this a BOJ resetting policy to make it more sustainable, or on the path to normalization? If it's the latter, we've had 10 years of yields being anchored by the ECB, by bonds, not just zero, but deeply negative, and by the BOJ and the JGB market. And what we've heard in the last 24 hours is that era is over. It's over. And if it's over and this bond market resets and they move away from yield curve control, never mind 50 on JGBs, I want to know where that resets without that market manipulation. And I think we can use it. You've said that word, not just manipulation, but artificiality of what we're seeing in Japan. That's not a market right now. Where we are
It is
this
not
morning
a
at 50
market right
basis
now.
points.
That is clear.
Are they going to
But-
test that new upper limit of that band at the Bank of Japan?
What's changing right now on this Wednesday is we're beyond the pandemic. We're getting this reset in Japan, in China. Except, Lisa, I've got the mayor of New York City telling me maybe we ought to be wearing masks. And I noticed the national COVID death rate going above 400. We were, 300-ish, even at times 280, 290, the good news of that. And we moved up. And I wonder where we are in the pandemic continuum, given the economic shock news we're seeing.
Well, to tie the two ideas together, are we post-pandemic? Is this the
Yeah,
post-pandemic
thank you.
reality of the trifecta of different viruses? And then what does that look like from a financial point of view? To John's point, do we have this gradual shift, or do you see more sudden moves on the heels of what's been telegraphed right now if it comes to pass in a more extreme
We're
light?
going to talk to not the leader, David Kotak here in a bit, and with his historic work on China and bird flu a decade ago, I'll say even 12, 15 years ago, to get an update on this linkage of pandemic and beyond it, and investment as well. John, I got to look at the data. What is there only? Well, I'm going to go with the VIX, John, 22 down to a quiescent 20.76 is a dampening.
Equities with a lift, up 0.7% on S&P 500 futures. We're trying to close out the year with some gains on a 10-year. Yield to lower by 2 or 3 basis points, 365.45. And looking out to next year in the bond market, QT at the Fed, QT at the ECB, and the BOJ. We heard from several guests yesterday. They think the BOJ is going to hike interest rates early next year. Now, that's a shift, isn't it, for this bond market? That's something we haven't talked about for a long, long time.
I'm not expert on it, but the mystery to me is inflation in Japan, and that was what their so-called QT will play off of. This is a joy, and in his outlook forward here for 2023, he is David Kotak. He's co-founder, chief investment officer of Cumberland Advisors, not only with a narrowness on municipal bonds and on the state of a given portfolio, but also looking at the broader, bigger picture. David, you do this 24/7. Are we beyond the pandemic?
No, we are not. Thank you for having me on, Tom, Lisa, John. We are not beyond the pandemic. We are in another phase. Otherwise, we wouldn't have so many millions of people getting sick in China. The pandemic is a global issue. In the United States, we've quit, we've given up, we've said we're not worried about it anymore. And we have, as you just said, 400 people die every day. This makes no sense, but that's who we are and what we're doing.
Well, David, it seems like that's what China's doing as well, at a point when this is actually slowing the growth in China, slowing the economy down because people are self-quarantining in a sense to avoid getting sick. At what point can we look at activity levels as the new post-pandemic normal, given that a lot of these viruses are just going to continue to circulate?
Yeah, well, that's true. And we now have in the United States 3 respiratory viruses circulating at once, and they're all dangerous. In China, we're on the surge, similar to where we were 2 years ago. So it has to run through. It's a fire burning through a forest, and it'll run for months, and then it'll settle down. And that's when China really starts to turn economically. Right now, it has to face the fire and the surge.
David, we've been talking all morning about how the market has handled a lot of shock events with pretty sanguine kind of shrug of the shoulders. If you think about the prospect of China reopening, if you think about the possibility of a true shift in the Bank of Japan's stance, do you think that this market has basically been through the worst of it? Or are you expecting, I want to say another shoe to drop, but a larger disruption in the face of perhaps a Bank of Japan dropping their yield curve control or a China reaccelerating?
Well, you had a great show this morning. You had Gina Martin Adams warning about earnings and talking about gradual deterioration in earnings. I agree with that. You've had discussions about the Japan shock, and you just articulated, is it a one-off or is it a trend underway, and this is the first step? I believe it's the first step. And Japan has to now normalize. That means their short-term rate will go up, their long-term rate will go up, their yield curve will change. And yesterday, with the Japan news, we saw immediate reactions in cross-currency interest rate swaps and the adjustments. All you would expect was a surprise.
David, one final question. We had to go in the Rolodex, the surveillance Rolodex. Folks, a Rolodex is the thingy where you keep your addresses on. David, I had to go back and find somebody who actually remembered 74, 75, 76. The year after that horrific year, we were up 38%, and critically the year following, we were up, I believe, 18%. Is that the shock for the next 12 months?
It's very possible. Are we going to repeat 73, 74? Cumberland Advisors was founded in 1973 with my partner, and our firm was launched in the midst of 73, 74. So I've been around on this and remember that. And I'm worried about a repeat of 73, 74, 75. And the Fed is too, Tom. That's why they don't want to repeat the Arthur Burns middle of the road trying to satisfy everyone. And that, I believe they're going to stick to their guns until they see an inflation rate they can accept. Torsten Slok's note this morning that you quoted just a few minutes ago is right on the mark. He says there's a gap between job seekers and job openings, whether it's his 5 million or J-PAL's 4 million. It's there, and that has to either close one way, immigration, change rules, or suppress demand until that realigns. That's what the Fed's going to do. I believe they're going to stick to the course, and therefore we have risk of more serious recession.
I will see. David Kotok. David, wonderful to catch up at year-end. Have a wonderful break. Enjoy the holidays, sir, and a Happy New Year. David Kotok there of Cumberland Advisors. I believed that after Jackson Hole and Chairman Powell's speech. I truly believed him, that he thought the risks of doing too little outweighed the risk of doing too much. He repeated that in the November Fed meeting. The risks were asymmetric. I just get the feeling the last few times I've heard him speak, it feels like that risk for him, that balance of risk has come into balance a little bit more going into next year. Now, maybe I'm wrong, but that's just what I'm hearing from the Fed chair.
We've heard it from Lael Brainerd. We've heard it from other Fed members, a real tone, the concern about causing too much pain that will be hard to reverse, especially with a higher unemployment rate. If there is this disinflation, the change in the narrative has come from the data, which does show a decline in inflation to some degree.
Do you know what Mohammed said yesterday? He said, I don't think they're going to change the price target, 2%. I don't think that's going to happen, nor should they because of credibility issues. But just raising the point that they might tolerate 3 to 4. They may tolerate that, Tom. Just tolerate 3 to 4. It's going to be interesting to see how this develops through next year.
Like yen strengthening, it is decidedly nonlinear.
One of the strongest lines we've heard, I think, in the last few weeks, Sarah House, Wells Fargo, the last mile.
Yes.
The last mile, get inflation down from 5 to 3, 3 to 2.
Great concept.
Tough. Futures right now up 0.75%, 8:30 Eastern Time. So that's 18 minutes from now. Maria Tadeo sitting down with Christian Lindner, the German finance minister. Do not miss that on TV and radio.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. President Biden will unveil nearly $2 billion in assistance and announce moves to deliver a Patriot missile battery to help Ukraine bolster its defenses this winter. Ukrainian President Volodymyr Zelensky is traveling to Washington today to meet with Biden and also address Congress. It's Zelensky's first trip outside Ukraine since Russia invaded in February. Now, a prominent research group says Brexit has left the UK economy 5.5% smaller and added to the squeeze on public services. The Centre for Economic Reform says that slower growth is also weighing on the Treasury's revenue and that the tax increases announced in the autumn statement would not be necessary if the UK was still in the EU's single market. The findings are the latest to highlight the costs of Brexit, which is limiting Prime Minister Rishi Sunak's effort to pull the economy out of a recession. Investors who are ready to turn the page on the worst year for equities since a global financial crisis should brace for more pain heading into 2023. That's the blunt message from top strategists at Morgan Stanley, Goldman Sachs and others. They're warning that stocks face fresh declines in the first half as corporate earnings succumb to weaker economic growth and sky-high inflation, and as central banks do remain hawkish. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
I definitely lean towards the fact that we've seen the highs in yields because, again, I think you look at what the bond market's telling you. It's telling you the Fed is going to win the battle against inflation. It's telling you growth is falling, not disastrously, but definitely going low. I mean, the Fed told us that where their prediction is for next year.
That was the brilliant Brian Whitestein a little bit earlier this morning from Morgan Stanley Investment Management. Great to catch up with him. And thank you for your letters as well. This came from Suzanne. This is going to feel like a very different show because it's holiday season. Tom, listen to this. It's addressed to me, but it's actually about TK. On the 12th day of Christmas, surveillance gave to me 12 interruptions, 11 guests are guessing, 10 scripts are ripping, 9 so important. You love a so important, don't you? 8 tangs for tippling, 7 cups of coffee, 6 trips to London, true, 5 crypto coins, 4 market checks, 3 Tots goals, 2 barrels of oil, and a Bentley on Park Avenue. Isn't that a great song? That was sent from Suzanne. Thank you for that.
Thank you.
It was brilliant. Do you want to? Oh, you want to sing it?
I think that
there's the lyrics.
It's good. We'll do that in the break.
Yeah, I'm going to celebrate that. We're going to be making eggnog in the 10 o'clock hour. But
well, as Greg Peters revealed, that already started a few hours ago.
Yes, it did. On radio, Tang Zero looks awfully good on a frigid.
Tang Zero's clear. Is that water? Is it? No, exactly.
No, it's Tang Zero. It's not as orangey.
It's nice to have Neil around the table with us.
It is.
Here in New York. Neil Dutter, Renaissance Macro.
This is important. We've been through a lot, but so much of this is the psychological structure of how you approach economics, finance, and investment. Neil Dutter, always writing with skepticism and humility, has said, would everybody calm down and remain optimistic on the American economics experience? He is at Renaissance Macro, and we get a rebrief today. The CEO of FedEx and the CEO of Nike agree with you on the path forward. That's what we've observed this morning.
Well, that's a problem because the bond market doesn't yet agree. And, that's really I think that's the tension. I mean, I think it was Gina in the last segment that talked about how we've been talking about recession for over a year. Well, I mean, and I've heard another guest talk about, self-fulfilling prophecies. So when everyone expects a recession, that's when that happens. Well, no, economics is not technical analysis. That's not exactly how it works. And how it works is through an element of surprise, Tom. And, companies, if they've been preparing for something and it doesn't materialize, then the risks start to build in the other direction. And I think that means that the risks, frankly, going into early next year are skewed to the upside for precisely this reason. Your own Bloomberg consensus sees growth of basically 0 in each of the next 2 quarters. That's despite a significant decline in gasoline prices. That's with, look, we basically had both the fiscal policymakers and the monetary policymakers shooting their bazookas at the U.S. economy. We had a massive fiscal squeeze. Remember that? Fiscal squeeze. It's going to help solve the inflation. Nice call. Didn't work out. And, look, the Fed, they've tightened 450 basis points inside of 12 months, and the U.S. economy still stands. And I think one of the things that people are looking for the catalyst, right? Like, what's the growth catalyst? To me, it's pretty straightforward. Shocks dissipate. Is the inventory squeeze going to be as bad in 23 as it was this year? Probably not.
That's what Nike said.
Yeah.
Today. In the
same thing with the fiscal shock.
So what's the data point that you throw at the skeptics right now? What's the number one data point on your dashboard that just screams this ain't a recession?
Well, the most obvious, of course, just look at the factors that determine recession. Real disposable income, real personal income net of transfers. That's growing because inflation is starting to moderate and incomes are still sticky. Industrial production generally on the rise, all deference to the ISM. Obviously, we've all talked about employment. Consumer spending is still pretty healthy. So, by the traditional frameworks of how you would, call a recession, we're just not there.
So, Neil, call me gloomy, but I hear what you're saying. And I say, okay, what's good for the economy isn't necessarily good for markets. And the scenario that you're painting, to me, doesn't scream any positivity because of one thing. Suddenly, if you have companies that are doing better than good, they can charge higher prices. That reignites inflation, especially if you get that fuel cost going up a bit and you get the sense that the Fed is going to continue to raise rates. So what's your pushback to that rates are going to go up, that there's going to be this feeling that bond yields have to go up that torpedoes some of that equity momentum?
No, I sympathize with that argument. I mean, it's sort of a heads I win, tails you lose type of situation here, right? I mean, if the economy is doing better and if the Fed is trying to slow things down, then the Fed has to respond by keeping financial conditions from loosening. And as a result, that would be bad for equities.
I look at the optimism you have, and you've been lonely this year. It's been a lonely Neil Dutta year. I was talking to David Kotak with a little bit of experience.
That sounds deep.
No, it's true. But, I was talking to David Kotak about the loneliness of 74, 75, which, I lived in Technicolor coming out of school. and the answer is we're sort of there again, and there the American economic experiment worked. And we can look back and go, well, that was then, this is now. You have an enduring faith in how America clears things, clears markets. As Bill Ackman said out on Twitter today, we find incentives and away we go. Do you have a faith in that now, that we will clear the system, clear markets, and away we go?
I don't know about away we go, but I definitely think that companies will learn ways to figure out their inventory short overhangs and things like that. I mean, home builders, for example, are trying to make it work, even though interest rates are so high. I mean, so companies find a way. But I think the issue for me really is that it's just about, for me, it comes back to this idea about positioning, right? And how the consensus economics community, companies, how they're looking at things going into next year. And I just think it's way too one-sided right now.
Can I put you on the spot on Fed funds? And I know this is hard to call, but do you see Fed funds finishing 23 closer to 4 or 6?
I think closer to 6.
Closer to 6.
I mean, I just think that. So I would put it this way. I mean, I think the Fed. You were sort of alluding to this. There's room, I think, for the Fed to step down because the inflation data probably gets better over the next couple of months. And if they've already greenlit 50 and you get a couple of better than expected inflation numbers, meaning they surprise to the downside, it doesn't take a lot to see, Lael Brainerd and others around the table talking about let's step down to 25. The question is, at that point, you raise the risk of the kind of stop and go situation because, again, you'd be slowing down into a potential economic acceleration.
Do you get the feeling they're conditioned by that flip-flop in the 70s, though? Is that weight...
I mean, they say they are, but it's human nature, right? I mean, it's just...
They say they are, but then in the last few times I've heard from Chairman Powell, I don't hear that from him in quite the same way. It feels like the Chairman Powell of Jackson Hole in November sort of went missing.
Well, to me, what was interesting at the last press conference was he kept talking about these are our best forecasts as of today. As of today, right? He kept saying that over and over, which to me tells you that maybe in a few months they won't be their best forecasts and things will change. And so you could well come back in March and the Fed may be revising down their unemployment rate forecast and revising down their inflation forecast and holding off on additional hikes as a result. So, that could be interesting.
Mark it on your calendars. Neil Dutta, a Valentine's Day inflation report.
Oh, beautiful. How romantic.
January 12 and the romance of 214. CPI inflation, Valentine's Day.
You're going to write that on the card to Mrs. Keene.
How are things going?
Clearly not well.
Core inflation has never looked so good.
Be your gift.
How do you think that's going to work out?
That's going to look out great. But to Neil's point, you get 1 or 2 data points. Even if it doesn't have to be dramatic. Even just nudging away. What does the Fed do?
Neil, can you stick around?
Sure. Well, remember, they also revised up their inflation forecast for 23. So the bar has been, you could say lowered a little bit.
What would happen if the dots went away?
Oh, this is his holy grail.
Oh,
you can think about that.
I'm not a believer in getting rid of that. I think it's a useful kind of tool to back out how they think about the world.
Well, they're getting rid of me now. I'm going.
Is this it?
They, meaning
finally.
Tom, I love you. Thank you.
Oh, please.
Lisa, I love you. To everyone in the control room, thank you. Please. Got another show to go, but just for this team.
Happy New Year.
Thank you. And to you too.
Have a wonderful trip.
And a Merry Christmas, Neil Dutta.
Are you doing a remote? You're outside Bloomingdale's for the night.
Yeah, I love that. Macy's. I'm all about it.
Bloomberg Surveillance. Good morning, everyone. On radio, on television, an eventful week. We're supposed to slide into the holidays, and we didn't. There was a small matter of Japan. We did that yesterday. It continues today. Yes, equities up here. A full 1% in the Dow, up 312 points. SPX up 0.8% as well. And we're watching dollar yen, continued momentum there with a 131 handle on dollar yen from that 150 level. And the stresses faced down, stronger yen, 140, 130 as well. Lisa, what do you see in the fixed income space this morning? Is it like, is everybody just checked out like Greg Peters was checking out earlier?
A little bit of a reversal from yesterday's momentary blip that you saw when it comes to yields higher. But right now...
Well, you're not tracked right now. I mean, she's there we are.
Here I am.
Check.
Well, no,
check,
this is John
Can I get
threw the
more
mark
kick
this
drum?
way when he left the studio. What we're looking right now is at a bit of stability after yesterday of what happened. I do want to just point out one of the biggest wild cards to me next year is going to be oil prices and gasoline prices. And we talk about disinflation. How much of that is due to oil prices coming down as much as they have, filtering into all of the manufacturing prices that can come down, or there's a little bit of a reprieve. How much does that picture change if gasoline prices, if oil prices continue to surge next year on the China reopening?
That is the unexpected, and maybe that's the epsilon out in the algebra of your guesstimates for 2023. What we're going to do is deal with a core formula here and go to what we've talked less about, and that is trade. Neil Dutta with this economic research head at Renaissance Macro, and we're thrilled you could continue with this. Neil, Y equals C plus I plus G, and then there's NX. For Japan, imports have been absolutely horrific. But for America, what is the variability or the size of our uncertainty given export and import dynamics?
Well, obviously, U.S. imports have been quite strong because our economy has been quite strong. So we've been sucking in a lot of imports, particularly imported goods, during the pandemic and really since then. What I think is going to change next year is, remember, the U.S. runs a sizable trade surplus in services. Right? A lot of people coming to visit the U.S. and so forth. And that has not normalized, and it's going to over the next year. And that's going to be, again, a tailwind for U.S. growth.
It's a tailwind, but then that comes over to the other side of the equation, not the international import-export, but domestic final sales, which is that resiliency of the internal American economy. You've been an optimist there. Do you continue to see domestic final sales?
Well, so far it's running pretty good. Yeah, I mean, look.
Pretty good, yes.
I mean, consumer spending is tracking, I think, close to around 3.5% in the fourth quarter. So it looks...
That's a nominal number.
No, that's in real terms.
That's in real terms.
In real
Excuse
terms.
me.
I mean, take a look at the Atlanta Fed GDP now. I mean, it's pretty healthy for consumer spending. We should get tailwind from auto sales will probably be a little bit better. That's going to add a decent chunk to GDP growth. So final sales remains pretty healthy.
Anti-Neil Dutta. But credit card receivables are like it's 21% interest rate. We're all going to die.
You can play that role. Go ahead. You want to do that for me?
But that's the other
Please
side
do
of it.
this.
Continue.
No, look, there is actually the other side is much more insidious than that, if you want to be honest. The other side of that is another leg up of inflation, right? I mean, that's the flip side to all of this, is that if you have strength and you have wages going up, and that's what we've been talking about, I really do want to go to gasoline prices. How much is that going to really drive so much of what happens next year? You said, it doesn't happen without a shock. Could that be the shock if suddenly you get a resurgence there without the response mechanism of the U.S. government releasing a whole lot of oil into the market?
Well, I mean, the big risk to the U.S. economy was really earlier this year when the Fed was hiking very aggressively, 75 basis point rate hikes per meeting, and gas prices were, like $5 a gallon? We're on the other end of that now. So the risks are somewhat lower, right? The Fed is seemingly stepping back, and gasoline prices are, looks like they're going below $3 a gallon nationwide on average. That, to me, is a pretty powerful combination for the household sector. So, to me, it leaves me somewhat more positive in the short run than not. It doesn't mean that oil prices can't go up next year, but, the effects are not immediate.
When you read all of the year ahead outlooks, which we've been discussing all morning, you laugh, right? And the consensus right now is you're going to have a bad half for the first one and then a good half in terms of equity performance. You've pushed back. You say that perhaps it could be reversed, that you get a really good first half and a less good second half.
I think that that's more likely than not. I mean, remember, I remember when I used to do these year ahead pieces working at, bulge bracket firms, research houses on the sell side. They have a shelf. You spend so much time doing them at the end of the year, and they have a shelf life of about a week and a half.
So you're a little resentful.
You publish it, you do your year-ahead call, and then it's over.
Come on. You do an outlook. We did this with Gina Martin Adams in the last hour. Maybe you missed it, Neil. Lisa, it's real simple. You do the outlook, and then you get on airplanes. It's just that simple. I mean, that's...
And talk to clients.
Everybody thinks this is a romantic
vacation.
business where Neil Dutt is having lunch at the St. Regis over on Fifth Avenue. No, you're at LaGuardia, and you're not sure where you're going after Omaha.
Well, but then this year, how much does that really live, that shelf life where you go flying around the world telling everybody this is what's going to happen? We think maybe we have no confidence because this is a changed moment. How much is this time different where the forecasts really are about what your inflation call is, what your sense of what the Fed's willingness to actually get inflation down to 2% is?
Yeah, I mean, to me, I think a good first pass in this business is really just follow the data. I mean, it's hard enough just to get the situation today right, let alone forecasting things 2, 3, 4 quarters from now, right? So let's just follow the data. And what do we know about the data? Generally speaking, it's been coming in better than expected, not only in the U.S., but frankly in Europe too. I mean, if you look at surprise indicators in Europe, they've been moving up. And what's interesting is even though those surprises have been building to the upside, what has the consensus been doing? They've been slashing their forecast for next year. So I think that kind of disconnect is pretty interesting. It's somewhat unusual, but I do think it creates sort of interesting opportunities for market participants.
Neil Dutt, thank you so much. Greatly appreciate it this morning. He is with Renaissance Macro. Joining us now as we look to the housing economy, the granularity of what home builders are doing. Jerry Howard is with us, the Chief Executive Officer of the National Association of Home Builders. Jerry, let me ask you a piercing, sophisticated question. How bad is it?
It's nowhere near 2008. So people who are thinking that the world is coming to an end here, it's not that bad. There's a natural floor to how low house prices can go because we don't have the same amount of supply we had then. In this instance, the supply shortage may help us keep from going way into the depths of recession.
So, Jerry, we have seen, although a huge pullback in terms of home builder sentiment. Your company has been tracking that. And at the same time, you have seen the number of starts surprise the upside. I mean, how is this going to balance out going forward? Is this actually going to reduce supply even more and cause prices to remain even stickier because of the lack of sentiment, the lack of positivity there?
Well, it's not only that. I mean, the lack of sentiment, I think, reveals itself in the decline in the number of permits that are being taken out. And last month, all those starts were not down as much as we feared they would be. Permits were down more than they feared they would be. And permits reflect the planning. Now, obviously, you take out a permit in December, you're not going to start work until February, March. And if we keep seeing permits stay down or decline even more, it'll mean that the spring building season will be in real jeopardy. And that's really sort of the primary indicator for how the year will be.
How much does that factor into your call that you think that there's going to be about a 10% decline in pricing next year, housing prices, followed by a rebound in 2024? What's the nature of the rebound if it isn't fueled by rates, but is perhaps fueled by just simply a lack of demand that's exacerbated by a weak spring season?
Well, I think the rebound will be dependent in part, just like your previous guest said, on the Fed slowing down and interest rates coming down a little bit more. There's still also a great deal of pent-up demand. I mean, unfortunately, the housing sector never got back to full production after the Great Recession. We were just about to come over the top and get back to running on all cylinders when the pandemic hit.
Right.
So there's still a great deal of pent-up demand. I think that demand, combined with a growth in other areas of the economy, I think will bring us back in 24.
Jerry, I sat with a guy once, back of the envelope. I think the kitchen cost $250,000. The rap here in America is home builders have been forced into only building McMansions and mega properties for the fancy rich people, boxing out the greater middle class in home ownership. Now you've got the overlay of private equity money like Blackstone, and the scare tactics are buying up hundreds and hundreds and hundreds of homes. How does this play out? You've only been doing this with NAHB and National Realtors for like 400 years, Jerry. How does this play out? How do we get back to middle-class home ownership?
You know that is something that I've been harping on for a long time now. And this situation is caused by one thing: bad policies. Policies that repress the ability of a builder to build a house for a first-time home buyer. They just can't do it and make it pencil out. So they're forced to build what they can sell. And they can sell to the rich and the upper middle class, the affluent section. We need to get our policies back to where we are promoting home ownership through the tax code, which it doesn't anymore, through subsidies, but most importantly, through an evaluation of overall American housing policy. Right. That hasn't happened since 1990.
Come on, Jerry. I grew up in this. I can tell by your accent, it's not North Carolina, it's South Carolina. I want to build a $242,000 home in South Carolina somewhere with 4 bedrooms, a 2-car garage, and a kitchen that doesn't look like it's out of a sitcom in Hollywood. We're not building those homes, are we? Why?
We can do it in places like the Carolinas, like Texas, like Florida, that keep regulations low. In places like New York, Massachusetts, California.
Okay, what is
impossible.
New York? What in New York here? What does New York need to do to begin to mimic the success of the Carolinas?
Reassess its regulatory policies. And I'll give you the extreme example, actually, is San Diego County, California, where over 50%, that's 50% of the cost of building a new home is in regulatory compliance. That's absolutely ridiculous, and that's why San Diego County has housing haves and housing have-nots.
Jerry, just quickly here before we let you go, thank you for being with us. Going forward, after 2024, what will the nature of a housing market look like, given that it really grew up under this ultra low and dropping rates? Do you see a sort of slow grind with much more stable valuations?
Yes, I do see a return to what would have been pre-Great Recession normalcy, where you'll see production equal out and top out at what it should be. And I think you'll see that bring stability back to the housing markets. Housing will always be a good investment because it is subject to so many vagaries in policy machinations. But I think you'll see a much more stable market in 24 and beyond.
Jared Howard, thank you so much. Just wonderful to have you on, somebody in the trenches of decades of the housing market and the politics of it in Washington. He is the NAHB, to say least. I'm sorry, Lisa, I don't want to get far away there, but what percentage of people watching in some of these major East Coast, and as he mentioned, San Diego, West Coast cities, California as a general statement, the dream is gone? I mean, the dream is gone.
Well, you're talking about lots of different places with different dreams that have evaporated. And I think that this is sort of, the San Francisco question of, well, if big tech's all working from home or working from whatever mountain they want to work from, where do you go in terms of a San Francisco real estate market? You have in New York with the office space, a similar type of story, but very different contour of a business. And then you have the sort of flood into coastal areas, how this shapes out, given how much that's been bid up in terms of housing in the Orange Belt, the Sun Belt. It's going to be a big question. I mean, I think that this is the hardest thing talking about the U.S. housing market. It's so different depending on what region you're looking at.
Well, yeah, I agree it's different, but there seems to be a polarity of the size of the land in the South and radically different economics versus almost the heartbreak that we see in the greater New York area.
Basically, low taxes. Move there.
Taxes is a huge issue. Some of these taxes I see are jaw-dropping, to say the least. Equity markets, a nice 1% move in the Dow. We do that for John Ferro.
He thanks you.
Stay with us. This is Bloomberg. Coming up, Maria Tadeo with the German finance minister. Bloomberg Surveillance. Good morning. Lisa Abramowicz and Tom Keene, John Ferro preparing for the next hour. And right now, as John has mentioned through the morning, the challenges of Europe, the many challenges. And as we heard from David Folkerts-Landau of Deutsche Bank many, many months ago on a difficult February morning, a Europe that at some point will need to rebuild. And that includes finance, which means it's an appropriate moment to speak with the finance minister of Germany, Christian Lindner. Here now in Berlin, Maria Tadeo.
Good morning, Tom, and good morning. And yes, we are joined by the German finance minister, Christian Lindner. Herr Lindner, how are you?
Thank you. Thank you for having me.
And of course, when I was preparing this interview and I knew that you were coming to our studios in Berlin, I thought, what is the first question I can ask Christian Lindner? And the answer is obvious. Inflation. When you hear, and I don't want to get you to comment on the ECB, but when you hear Christine Lagarde say inflation is now our #1 priority, we have to bring it down. There's no questions. Is that a good thing for you?
Yes, of course. I completely support the language of the ECB and its measures. It's our top priority as well to bring down the inflation rates. They are a serious risk for the economic development, for people and businesses, the investment conditions. And so it's our fiscal priority to reduce inflation rate. It's the responsibility of ECB, but we play our role as German government and European governments.
So as a German finance minister, this is where you say this is top of my agenda. It's inflation.
It's top of my agenda, not only now in December. When we hosted the G7 meeting in Bonn and Petersburg, we underlined that bringing down inflation should be our top priority. This has been before the policy change of the central banks, and I think it proved to be right to do so.
So you say we were proven right on the analysis. That's for the inflation, but then there's the growth story. And you know there's a lot of negativity around the German story on the medium term and the short term perhaps. It's the energy crisis. It's potentially the blackouts, the gas. When you look at the German economy, do you worry about a recession? Do you predict yourself a recession?
This year has been difficult, of course. We were harmed by the Russian energy war due to our too high dependence on Russian energy imports,
that was a mistake,
of course.
Would you say now?
Yes, had been a mistake, but now we have changed our policies. With light speed, we are improving our energy infrastructure. We are bringing more capacity of renewable energy to the grid. And, well, who thought that Germany would be able to build new LNG terminals in less than 1 year?
You have done it. And
I assure you, this is the very best moment to invest in Germany. This is the very best moment to buy bonds.
the best of international business is watching you right now, and that's your pitch. But let me ask you again, though, on the recession, is there too much negativity built on the German story? Some people say this recession is inevitable. For you, is that story overblown? If there is, you will recover fast.
We will recover fast, and in the midterm, I expect a very positive perspective for the German economy. Look, we are improving the framework conditions for private businesses, immigration into the labor market will be less bureaucratic than it had been. We invest a lot, public and private money, in the transition of our economy. There will be some tax benefits for investors in Germany. So after fighting inflation, my second priority is strengthening the German competitiveness, and we will do.
And you say that we'll do it. And of course, the crucial question, especially for Made in Germany, I know you like Made in Germany. You speak highly about it, and I know you particularly like cars. But my question to you is, when you look at the Inflation Reduction Act, Can Germany stay competitive when you have the United States coming in with such an aggressive policy on subsidies? Is that something that worries you? Are you on the phone with your U.S. counterparts? What do you want to see out of this?
On the one hand, the German car manufacturers are competitive. I think they
don't fear Tesla?
No, we mustn't fear Tesla. Tesla produces in Germany as well, near Berlin. But I think the German manufacturers, they are innovative and competitive. And, they have plants in the United States as well. So I think they are less harmed by the Inflation Reduction Act than public opinion in Germany thinks. But on the other hand, I take the Inflation Reduction Act seriously. I have my concerns regarding a fair level playing field between the US single market and the European Union. And this is why we need to negotiate. I'm in favor for waivers for the European businesses in the US
so you
market.
want the waivers. You don't want a trade war. What you want to get is the waiver in 2023.
We have to avoid any kind of trade war.
No trade war.
Instead of trade war, we need trade diplomacy. We need new free trade agreements. At least we have to make efforts to find a level playing field in the perspective of a free trade between US and European Union.
And what do you say perhaps to some critics in the United States that argue, yes, Europe is in a mess, but this is not our fault. Why should we give you any waivers?
Value partners, who we are, should be preferred trade partners, I think. My vision is a free trade zone of liberal democracies in the world. And one of the first steps could be to improve the trade relationship between United States and European Union. We would benefit both from this idea. And, well, I think there is an openness on the US side when I remind you of Janet Yellen's idea of friendshoring. And the Inflation Reduction Act should be reconsidered with respect of friendshoring.
And you're optimistic that can happen. Let's talk about today President Zelensky will be meeting with President Biden. Of course, it does feel the Ukrainians worry about lack of momentum and lack of support as time in the war drags on. When it comes to Germany and the European Union, will you foot this bill no matter what? And there's a very serious question about the reparations and what to do with the Russian central bank assets. In your view, who's going to pay for this? Because we're talking about potentially $1 trillion in reconstruction. It's a massive bill.
At the moment, there are the current needs of the Ukraine which have to be met. The European Union has decided on the macroeconomic assistance plus 18 billion euros next year to support the state of Ukraine. And we will continue to support Ukraine with military goods, such as artillery. And then, in the midterm, I hope the sooner the better, then we will have to find ways for the reconstruction of Ukraine. And, okay, there are reparations, there is macroeconomic assistance, we have the multilateral banks, we have the international financial institutions such as the IMF, and the Ukrainian economy itself. I think they have very good perspectives, they have natural resources, qualified labor force, so I think they have a very good perspective after the war.
I have to let you go, but I have to ask you this question very briefly, yes or no. What's going to recover faster, the German economy or the German national team? Because the World Cup was not good for you.
The economy.
The economy, wow, that's a strong bet, because you have 2 years until the Euro Cup, and you host it right here in this country.
Economy will recover faster.
Oh, well, that's a good prediction to make. Well, Mr. Lindner, thank you so much. Appreciate it. Always good to see you here in our studios in Berlin. Tom?
You are ruthless. I mean, Maria, it's just.
I had to do it,
I just
Tom.
can't wait for the friendly of Germany and Spain. It's just going to be. We'll have team coverage. Maria today.
We were 0-0
with Mr. Lindner of the German government, their finance minister. 4:30 p.m. A press conference. President Biden, President Zelensky.